New York City, I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief.
You've got stock futures rallying here this morning. The 10-year yield back above 4% after weaker jobless claims, easing some fears of a recession. Treasury yields here, like I just said, higher here, now just below that 4% level. So let's get right to it. The three things that you need to know to start your trading day. Yahoo Finance's Josh Schaefer, Jared Blickery, and Alexandra Canal have more.
Stock futures and treasury yields are higher after initial jobless claims clocked in at 233,000, less than the 240,000 economists had expected, and less than the previous week's revised levels. The new data providing a counterpoint to signs of a weakening labor market. This comes after July's jobs report came in much weaker than expected, with the unemployment rate jumping to its highest level in nearly 3 years. The jobs report partly responsible for a global sell-off, exacerbating fears that the U.S. economy is slowing.
And investors are keeping a watchful eye on the tech trade. Shares of Nvidia regaining some of its losses this morning after falling more than 5% on Wednesday. The sell-off in Nvidia and other chip names came despite a bullish note from Piper Sandler analysts published Wednesday, pointing investors to a, quote, tremendous opportunity to buy some chip names following the sector's recent sell-off.
And shares of Warner Brothers Discovery are tumbling. The stock is down more than 10% after the streaming giant took a massive $9.1 billion impairment charge on its cable business in the second quarter. The company also reversed earlier profit trends in its streaming business despite adding nearly 4 million subscribers. Overall, the future remains unclear, especially after the company lost a key media rights deal with the NBA. Wall Street is warning that the loss of those rights will impact the future success of its streaming service Max and will likely quicken the demise of its linear networks, which are already in free fall.
Stock futures higher this morning after initial jobless claims came in lower than expected. The data comes after last week's July jobs report, and that came in much weaker than expected, which drove up recession fears and prompted traders to price in a bigger rate cut at the Fed's September meeting. Here to break it all down, we've got Yahoo Finance markets reporter Josh Schaefer. Hey, Josh.
Hey, Brad. Yeah, so weekly jobless claims coming in at 233,000. That is below the 240 that was expected, below the 250 that we saw last week. And largely, I think it seems like investors are just taking a deep breath after this, after all the discussion after the July jobs report about slowdown in the labor market. I think really the risk here was that this number was going to come in hotter than expected, and the market might freak out based on that. There's potentially even another read through here, just thinking about this report. The fact that NASDAQ futures went from flat to up 1% on a highly volatile weekly economic data set that comes out every week and is almost always revised. Maybe the takeaway from this report is just still that we are in a very volatile, unsure market right now. I think that's something that I'm sort of thinking about as we digress on this.
Josh, what do you also just sticking with that volatility theme here real quick, as you look ahead to next week when we get more prints coming on inflation, just taking a look at how volatile and how, I guess, the dramatic reaction to this print was. What does that then tell us? And it's something that strategists have been talking about, especially here this week following what played out on Monday. But really what that tells us maybe about how large some of the swings could be in the markets here in the coming weeks.
Yeah, you guys had Stuart Kaiser on from Citi yesterday, and he tracks this pretty closely. And he said that the options pricing heading into today was about in line with next week's CPI report, Jackson Hole when Ched Fair Powell is going to speak, and then also Nvidia earnings. So that gives you an idea of just how volatile things feel right now, that again, a weekly data set is basically in line with CPI. And I think, Shauna, looking forward to next week, again, this is not normally, it is in focus because we're talking a lot about the labor market and we're talking about a slowdown, but the actual weekly numbers are not always the most reliable numbers. And so I think when you look at something like CPI, that's going to obviously have a lot more weighting on, it normally has a lot more weighting on how investors react. And right now, it feels like we just stopped talking about inflation for the last 2 weeks, maybe rightfully so, but you certainly have a lot of risks around that, right? We're at a point now where it feels like we're talking about a labor market slowdown and inflation is just simply coming down, and we're back to that place where everyone just assumes inflation's falling. That doesn't mean that we can't have one print that comes in slightly above expectations and you get a freak out. So I think that is one of the larger things going into next week when, again, we have more actual data.
Yeah.
This was the only real economic data point we had this week outside of services on Monday.
Which is kind of
that's
amazing
why
given
everyone
the moves
is
in the
focused.
markets too, yeah.
Right.
And it also explains then why we're seeing such a dramatic move.
We haven't stopped talking about inflation, Josh. I mean, we've been having some CEOs from big retail companies, household names like Edgewell. We were speaking with their CFO just a day ago and talking about what they've needed to do ultimately to make sure that they're kind of offsetting some of their own expenses right now. And so that's the big conundrum that corporations are facing, knowing that they might still be part of the inflation problem if they need to pass on price, where volumes right now are sputtering even as well. And that's what investors are paying close attention to too.
Yeah, I mean, inflation is going to continue to be part of this story, right? I think the trend there needs to keep falling for people to be able to focus on the labor market as much as we have over the last week.
All right, Josh, great stuff. Good job breaking all this down, exactly what this means for our viewers. We appreciate it. All right, well, let's stick with this top story of the day here, the latest print that we're getting on jobs. Jobless claims coming in just lower than expected. It's offering some relief to the market. You can see that playing out on the screen right now. You've got the NASDAQ futures up just around 1.2% here ahead of the open. We want to bring in Lindsay Pieggs. She's Stifel's chief economist and managing director. Lindsay, it's good to see you. So let's focus on the economic side of things, obviously. When you take a look at this print, maybe offering some relief, especially on the heels of what we saw last Friday, what's your first take?
Well, I think it's a relatively solid number, and it offers an indication of still positive conditions in the labor market, helping to offset some of that rising concern that circulated through investors and the marketplace in the aftermath of a less than solid July employment report. Now, that being said, even when we look at what we saw in terms of the non-farm payrolls report last month, we're still talking about relatively positive job creation. Now, there's no doubt that conditions in the labor market have cooled from earlier peak levels, but this morning's report suggests that that may be more of a normalization in terms of conditions as opposed to an indication of outright weakness lurking around the corner.
Okay, and so around the corner from here, we're also waiting to see what type of steepness we get to a Fed cut and what that policy going forward looks like. What are you anticipating?
Well, it's going to come down to the inflation numbers. It's going to come down to whether or not the Fed gets that needed confidence to justify a rate reduction near term. But right now, looking at that July statement, it's clear the Fed is not at that point. The Fed does not have confidence that we are on a sustainable disinflationary trend. So the next several inflation data points are going to be key. But it does appear as if the onus is on the data not to convince policymakers not to cut rates. So meaning if we did see a minimal 0.1 of a percentage point decline in some of these key price metrics, I think that may be enough to justify the Fed to move in September at a very tempered 25 basis point clip. But even so, if it takes just one data point to get that confidence, I don't see the Fed acting aggressively going forward, meaning it's likely that we see a very slow, controlled pace of reductions, keeping the level of Fed funds well above neutral out beyond 2025.
Lindsay, we've been talking to a number of economists really over the last several weeks, but in particular this week, and some have been very critical of the Fed, saying that they should have cut at the last meeting, that some of the data points that we've gotten here most recently once again prove maybe that the Fed is behind the eight ball on this. What do you think?
I don't think the Fed is behind the curve at all. I think the data has improved. But when we look at inflation, we saw several months of head fakes at the start of the year throughout the first quarter. And with April little change, June and July are really the only data points that the Fed has as of late to suggest we're back on a downward trend in terms of price pressures. And 2 data points fall short of the Fed's threshold of many data points needed to instill that level of confidence to justify a policy change. So, no, I don't think the Fed is behind the curve. The Fed is beholden to that threshold that they set of many good months. They're waiting for the data, and if the data cooperates, if the data comes in under expectations or as expected in terms of improvement, they will continue to move forward. If it doesn't, the Fed is willing to remain on hold beyond investors' expectations.
How much further fallout do you think that means for the labor market?
Well, the labor market, again, is still very solid. When we look at the average pace of 2024, we're still talking about creating over 200,000 jobs on a monthly basis. And yes, the unemployment rate has ticked up as of late, but at 4.2%, we're still well below the Fed's lower bound of what they designate as the full employment range. Wages are still solid, up nearer 4%. And so we're still talking about, again, labor demand outpacing labor supply, perpetuating tight-ish conditions, slightly less tight, but still tight-ish. So the labor market is still faring very well, providing support to the economy, the consumer, and making it difficult for the Fed to justify a more aggressive move to the downside in terms of rate cuts.
Lindsay Piegza, who is the Stifel Chief Economist and Managing Director. Lindsay, great to see you. Thanks so much for taking the time. Well, let's take a look at the Mag 7 trade. We're seeing green on the screen here today, or pre-market. Some of those stocks getting a boost with the markets this morning. The AI darling Nvidia might be up pre-market, but it's certainly a laggard this week. The stock is off more than 15% the last 5 trading days, and the shares were hit in the broader sell-off, in addition to news of a delay in its Blackwell AI chips. But the stock had already been trending lower. Nvidia off more than 20% in the past month. And between investor hesitation around high valuations and the sell-off, it's had Wall Street wondering if we'd see a big buy the dip mentality, but we're certainly not seeing that reflected in the share price, at least right now. There you're taking a look at where things ended the day yesterday. As of right now, we're actually seeing things pre-market moving higher by just a little bit for Nvidia and hovering around that $100 mark, which of course is a psychological level, at least at this juncture, for some investors perhaps who had remembered that that's what the stock essentially was brought down to once that 10-for-1 stock split went into effect. And so now is the larger question of, will $100 be an attractive entry point for those investors that are already not part of the long-term thesis for Nvidia at this juncture?
Yeah, I think we've heard from a number of analysts on the show, even over the past 2 weeks, that Nvidia looks a lot more attractive at these levels. You just had Piper Sandler come out yesterday saying after this sell-off right now, they think Nvidia is very well positioned. But when you take a step back, aside from some of the calls that we're getting from Wall Street, and just take a look at the moves and specifically what we saw yesterday, because actually when we were on air, we actually saw Nvidia trading to the upside. It then quickly gave up those gains shortly after we got off the air, and then those declines continued into the afternoon and closed off just about 5%. And a big reason for that was not specific really to Nvidia, but what we're seeing more broadly play out across the chip sector. And yesterday we heard from Supermicro Computer, actually they reported after the bell on Tuesday. The move was yesterday, though, and those shares plunged on disappointing earnings. So we saw a bit of a ripple effect. It dragged down Nvidia, but that's not closing lower. Also weighed on a name like Intel, which has been struggling for quite some time, but especially ever since we got that earnings report just last week. So again, I think there's a couple of things at play when you talk about valuations, when you talk about some of the weakness more broadly playing out within the chip space. You also you factor in that information report over the weekend that we could see a delay in Blackwell chips. Yes, that has been contributing to the declines that we've seen in Nvidia, but at least when you take a look at the street's reaction, consensus seems to be that Nvidia does look attractive from these prices. Not to say that we aren't going to see more pressure on the stock, given the massive run-up that we've seen year to date, also what we've seen over the last year. But again, there does seem to be a number of reasons to remain optimistic on this name in the future.
Yeah, certainly. Of course, that earnings report going to be coming out August 28th. We'll see if it's the bellwether that it's been in the past for earnings seasons as well.
Yeah, and many are saying that that's actually going to be the catalyst then for the stock. All right, let's talk about Warner Brothers Discovery. Shares are sinking this morning, off just about 10% now in pre-market trading. Second quarter results showing that it took a $9.1 billion impairment charge related to its TV networks unit. Yahoo Finance's senior reporter Alexandra Canal has the details, and Allie, it doesn't look good.
It doesn't look good, and really it's that $9.1 billion impairment charge that sticks out here. And the timing of this, it shouldn't be all that surprising considering we have the loss of those NBA media rights. This was something that was brought up on the call, although management didn't get too in the weeds there, considering WBD is currently in that lawsuit with the NBA. WBD did sue the league over what it described as, quote, unjustified rejection over its matching rights proposal. But the CFO did call out a number of triggering events in the second quarter that led to this charge, including that uncertainty related to affiliate and sports rights renewals like the NBA, also the difference between the company's market cap and book value, along with continued softness in the U.S. ad market. He did go on to say that this charge charge also represents the value shift across the business model towards streaming along with the studios business. And this is something that we've heard from multiple companies this earnings season, especially those legacy media giants, this clear transition from cable to direct to consumer. But that transition is costly. And if you have a company like Warner Brothers Discovery, which is just drowning in debt after its merger, the longer that it takes to delever that balance sheet, the more unhappy investors are going to be. It might also impact credit ratings, which is something to watch moving forward. But analysts on the street out there, they think the stock could be trading at a discount. There is a general vibe that things are going to improve in 2025. KeyBank analyst Brandon Nispel, he reiterated his outperform rating on shares, maintained his $11 price target, and says he believes that things are unlikely to get worse at this point. And you also have to keep in mind, and this is being a bit overshadowed in this report, but the streaming side of the business is doing pretty well so far. They added nearly 4 million subscribers in the quarter. There's strength in direct-to-consumer advertising. That's offsetting some of the accelerated losses that we've seen in linear. And on the call, David Zaslav said that they believe that subscribers will continue to improve. They think that they will reach $1 billion in segment EBITDA by 2025. So, there's positive catalysts in the future, especially if you think about that sports streaming JV, the bundling opportunities, but these are challenges that are really being felt across the industry. I know, and we have Paramount after the bell today too.
I just think, what is the consensus? Is there a consensus about what is going to happen with this company? Whether or not it is going to break up, what exactly that is going to look like? Whether or not there's even going to be appetite or demand for what they want to do? And you talk about that impairment charge, and that's really at the heart, maybe, of some of that confusion or maybe unknown at this point as to what exactly the direction looks like.
There's been a lot of chatter on Wall Street. A lot of analysts have come out and said, look, maybe you spin off, maybe you combine certain businesses. On the call, they addressed this. They said, look, we know that there are rumors out there. They talked around it a lot, and they said at the end of the day, they want to operate as a one Warner Brothers Discovery, but as a publicly traded company, they have a responsibility to deliver value to shareholders. So it seems like this is something they're internalizing, they're thinking about. No plans yet, but I think we're going to see some sort of move in the next year or two.
We will see. All right, Allie, great stuff. Thanks so much.
Thank you.
Coming up, we're going to take a look at Eli Lilly shares. They're surging on strong demand for its weight loss treatments. We're going to break down some top movers on the other side of the break.
Eli Lilly shares surging this morning after its second quarter earnings and revenue handedly beat expectations. The company also boosted its full-year revenue outlook on strong demand for its weight loss treatments. Yahoo Finance's senior healthcare reporter Anjali Kemlani joins us with the details, the breakdown here. I mean, if you had a penny for every Mounjaro reference that they made, you could retire.
Pretty much, yeah. Listen, and this is the second time this year they've had to upgrade their guidance. That just tells you how well they're doing. And this is different from what we saw yesterday with Novo, who I'm sure wishes they had this type of earnings to report. So up $5 billion in guidance for the year. But let's take a look at what came in for the quarter. So $11.3 billion for the actual revenues versus the estimates of $9.98 billion. That is a 13% increase. And take a look at adjusted EPS. That is a 45% increase from the estimates versus the actual. And this is all being credited to Mounjaro and Zepbound. Zepbound really on a, I mean, it's a rocket ship, that one, because the amount of time it's taken to reach $1 billion is much shorter than any of the previous GLP-1s. We've seen that. And we know that the sales, in fact, follow that. I mean, 800 million was the estimate, and they came out at 1.2 billion just for Zepbound. So taking a look at that. Meanwhile, Mounjaro, 3.1 billion versus the estimated 2.4. So if that isn't an indicator of what to expect for the rest of the year, don't know what is. We also know that they have finally gotten off the shortage list. So both drugs are no longer on the FDA shortage list, which means that we know that the supply constraints are a little bit easier for the year. Lilly also had a couple other sort of interesting notes, not directly tied to revenue just yet, but some milestones to keep a lookout for, because now with this supply constraint issue under wraps and expanding into other global markets, the company is now looking at expanding the label, just like we saw for Wegovy and Novo. So they're looking at sleep apnea. They filed for that both in the US and in Europe. We also know that they started their Alzheimer's therapy, Kisunla. So that's going to be out on the market as well soon. And they've also started looking at the oral therapy. That's also further down the line. So, you know, little bits and pieces being put together to make this really just a bull case for the company.
All right, we're going to be getting analyst reaction coming up in Catalyst too. But again, when you take a look at the reaction, lots to be excited about. And like you said, it was pretty amazing how many times they were. And it makes sense, right? They want to brag about it. It's almost like the AI kind of keyword here for the pharma industry, and it's paid off.
I mean, people want it in a portable form too, it seems like.
That's one.
I'm not joking. It's in there.
The oral form of it is like one of the key things that we're going to be seeing, whether or not the market is there for that, and because the efficacy could be less. In fact, CEO Dave Ricks did say it could be less. So that's going to be the question. Do people want something that's easier to carry around and easier to take, or are they going to want something that's more efficacious and depend on how long they're going to stay on that? That's something that's we're going to have to watch.
I need something on the opposite end, something's portable that helps, retain or put on more, just secure the gains or something like that. An alternative to muscle milk or something.
All right, Anj, thanks so much. Let's take a look at shares of Under Armour. It's moving higher on signs that its restructuring efforts are paying off. The retailer raising its adjusted EPS forecast with its newly reinstated CEO, Kevin Plank, saying he is, quote, encouraged by early progress. So he's trying to take the wins where he can. This is a company that has been struggling for quite some time. Lots of questions about the turnaround I should just say, taking a step back, what the direction of Under Armour is ultimately going to look like now that it's back under Plank. Questions about whether or not the turnaround is going to be as successful as is hoped right now from the street. This is a stock clearly that has underperformed now for quite some time. Over the last 3 months, still in the red. Year to date, you're looking at losses of just over 25%. But at least today, Brad, the street is encouraged by what they heard.
Okay. Well, they really tried to put some lipstick on this one, saying that they're encouraged by the early progress and the efforts to reconstitute the premium positioning for Under Armour brand. Pleased with the fiscal first quarter 2025 results ahead of expectations. Expectations must have been pretty low because ultimately North America revenue, that decreased 14%. Wholesale revenue, that decreased 8%. And then apparel revenue, that also decreased 8%. Footwear revenue, that was down 15%. Need I go on here? There's a lot that still needs to take place for the turnaround here. And I don't know, maybe they need to lean more into, and especially in a year where you've got the Olympics taking place, you also have a lot of fanfare that is being drummed up around athletes across sport right now. This is a prime opportunity for any of the athletic apparel and footwear manufacturers to really lean into some of those key athletes that they do have. Steph Curry is one of them for Under Armour, and we're still waiting to see what the next iteration of kind of the Curry brand development looks like going into later this year. I wish that it had taken off more or done more in golf, especially, that I love being out there in nature and just yelling to the sky sometimes on weekends. So at the end of the day, there is so much that they've done on Curry brand in basketball and branched that out into golf successfully. I would love to see what that does in other sports, kind of like Nike is doing with Jordan brand, trying to take that. You're just laughing at me now.
I'm laughing that you equated golfing to being out in nature.
You are in nature. Unless it's TGL. TGL's doing the whole indoor simulator thing. Tiger Woods, Rory McIlroy, big investment.
Yeah.
We'll see if that works out.
I don't know if I'd say someone's a big nature person if they're out there on the golf
I'm a big
course,
nature person. Yeah.
I'm not saying you're not a big nature person, but I don't know if you're on a golf course lends to that. Discussion for another time.
Sure. You make a fair point.
Let's take a look at shares of Boeing here. We're watching that stock. It's up just about 0.5%. CEO Kelly Ortberg taking the helm. His first day is today. He wrote an email to employees, and in that memo, Ortberg telling staff that the company has, quote, a lot of work to do to restore trust, and I think that puts it lightly. A couple of things that stuck out to me within this memo was the fact that he went on to say, I will be transparent with you every step of the way, sharing news on progress, as well as where we must do things better. Also saying we clearly have a lot of work to do in restoring that trust, and he's confident that working together, we will return the company to the industry leader that we all expect. He's expected to tour the main factory floor near Seattle today on his first day. He's also planning, I believe, to relocate to the city, to Seattle, which we know is at the heart of Boeing's activities here, in order to try and kind of recoup some of the lost trust there when you talk about the manufacturing, what exactly takes place in Seattle. So he's reaffirming his commitment to that city. He's laying out his plan for the company going forward. And I think at this point, investors have been encouraged, were encouraged. You saw that from the share price reaction once Kelly Ortberg was named as the new CEO. And now, obviously, he's facing a tremendous amount of pressure to right the ship and do it quickly.
Yeah, I mean, when you're on I-5, you can't miss Boeing's manufacturing operations. They used to do tours over there in Seattle, too. I hope they started to bring that back. It was kind of a COVID thing that forced them to kind of shut that down. But this, of course, the first day where it's really going to be a larger question of how much can the corporate culture under a new leader change, and a new leader that's going to have to steer in a Spirit Aerosystems as well as part of being able to kind of bring even more control to the operations and the manufacturing procedures here.
All right, so Boeing, a name to watch today. All right, all your markets action, we've got that coming up. The opening bell on Wall Street. Again, you're looking at gains across the board following that jobless claims number coming in just below the street's expectations, reassuring some of the skeptics that maybe the labor market isn't as weak as feared. We've got more when we come back.
All right, that's the opening bell on Wall Street and in Midtown Manhattan at the NASDAQ. At the NYSE, you got Goldman Sachs Asset Management. And at the NASDAQ, looks like you've got the great folks from Arrakis Life. Is that a B? It's a B. Abacus Life ringing the opening bell at the NASDAQ. All right, we are off into the races here on the day. Yeah, hit that button. Let's officially going to start things as funfetti rains down at the NASDAQ. Let's take a look at the major averages here. And the NASDAQ, the S&P 500, and the Dow right now. The Dow and the S&P 500 opening higher here right now, and we're waiting for that NASDAQ to calibrate here. You're taking a look at some of the activity that we'd seen yesterday, and now, there you go. You're taking a look at a calibrated NASDAQ on your screen. It's up by about 1.4% to start off the day.
All right, let's head over to Yahoo Finance's Jared Blickery is closely watching some of the gains that we're seeing here at the open. Jared.
That's right. I'm trying not to get too excited about some of these fluctuations. We have had elevated volatility recently, and I'll just show you a picture of the S&P 500. A 3-month chart shows you that we're back to the flat line, number one, but we've seen these candles get bigger and bigger on the way down, and that is just a bigger range in price action every single day. And we take a look at the 10-year T-note yield. We can see that has been climbing back up, and I'm going to put a year-to-date chart and show you technically, it has climbed, let me draw that one more time. It has climbed right back in to an important technical level. So we'll have to see if that acts as resistance or we go back into the range. But the point is that we could see an inflection to the downside in rates just here. And before I leave the screen, I want to check in on the VIX, which has been quite elevated itself recently. You'll see that's a year-to-date chart. That huge spike is what happened just a few days ago. I'll dial this down to a 2-month chart, and you can see it's kind of consolidating in a little wedge there. A lot of times what happens is it'll just consolidate, it'll break to the upside or the downside. We don't know which, but we'll have to wait and see what comes of that. Now let's take a look at the sector action. Tech and healthcare are the outperformers today, each up about 1.5%. Utilities, staple, and real estate, the defensive sectors are the one in the red, so pretty bullish outlook for the day. Let's take a quick look at the NASDAQ 100, and lots of green here. Nvidia up 2%, Broadcom up 3%, so it looks like semiconductors doing okay. And I want to get a check. I was looking at consumer discretionary versus consumer staples, and this is over the last month. What you're going to notice is staples here in the blue line, that is positive. That's up 1%. It's consumer discretionary where you see everything from Target to Tesla. That is down 9.6%. So that's kind of one of those orange warning signs that we got to pay attention to in the market. If we see consumer discretionary reassert versus staples, that kind of puts us and keeps the bullish theme intact, guys.
All right, Jared, thanks so much for breaking that down here. Again, stocks moving to the upside here this morning. Jobless claims coming in lower than expected. That was the catalyst here to the market in pre-market trading. It's easing some of the fears that we saw creep up in the streets surrounding recession. Now, this comes following last week's jobs report that really painted the picture, I should say, of a weaker labor market than maybe the street had initially factored in. And that contributed to that massive sell-off that we saw starting on Friday, carrying over into Monday. Many factors, though, contributing to that. So let's talk about what all of this means and where we could be headed for that. We have Kevin Gordon. He's Charles Schwab's Director and Senior Investment Strategist. Kevin, it's good to see you. So at least let's start with today's reaction, right? Because we are seeing some optimism maybe return to the market. The jobless claims number there reassuring maybe some skeptical investors out there that the labor market wasn't as weak as maybe initially feared. What's your take?
Yeah, I mean, I think it's definitely probably because it was the only major data point this week. It was a pretty thin week for data. So, I think it's understandable why so much attention has been put on the claims number. Very good, definitely not consistent with, the sort of weakness in payrolls that you would typically see in a recession. Definitely not consistent with even the uptick that we've seen in the unemployment rate. But, to your point about this weakening jobs picture, what was sort of amazing to me, especially on Friday and over the weekend, was this sudden realization on the part of a lot of pundits and strategists that all of the sudden the labor market is weakening. A lot of these trends have been in place for a while, whether it's a slowdown in wage growth or whether it's this drift higher in the unemployment rate or even just the monthly change in payrolls, which has been decelerating. I think probably the miss in expectations for payrolls coupled with that 20 basis point jump in the unemployment rate was probably where a lot of the fears started to kick in. But even if you look at some of the innards of the unemployment rate itself, triggering the SOM rule, yes, a bad thing. But if you start to look at things like the employment to population ratio, even for the prime age group, it's still rising. There's still a lot of inflows into the labor force and it's expanding. So those things are not yet consistent with what you would typically see at the beginning of a recession or the economy already being in a recession. I think that's an important distinction to make, especially because we know that the cycle in many ways has been incredibly unique, especially when it comes to labor.
Is the rebound fully in effect at this juncture, or do you think there's more slippage that we could see?
I'm not sure we've fully gone through the process of, kind of you get oversold, you rally a little bit, then you have some kind of a retest, and then you get some sort of a breadth thrust. We're probably in the middle of that second and third stage, because you definitely got to oversold in many areas, specifically tech-related and anything, if you're using the sort of the NASDAQ 100 as a benchmark for that. I think the more important story in this entire sell-off has been the fact that there hasn't necessarily been this, outright collapse or weakness, and certainly they haven't been the laggards, being the cyclical parts of the market. So even if you go back to the past peak for the S&P, mid-July, the only two sectors that are underperforming the index are tech and consumer discretionary. Clearly there's a consumer weakness play, I think, with the latter, but tech has been definitely the culprit there. If you look at some of the more traditional cyclicals, whether it's financials or even energy, they're still down, but they're still outperforming the index. And of course, there's been a little bit more of a traditional defensive play, with utilities and staples doing relatively well. I know Jared was just showing that chart with staples outperforming. But I don't think that if it was this declaration on the market's part that we were definitively going into a recession and the labor market was falling off of a cliff, I think those areas of the market would be doing much more, much worse. So the fact that it's more concentrated in a sector like tech at least tells me that it was part of more maybe of an over-leveraged or overcrowded trade.
Kevin, I'm curious what you make about the reaction that we've seen so far this earnings season, because those that are beating are actually getting rewarded relatively well. Those that are missing, we're seeing this downward pressure. What do you attribute that to? And I guess, what does that then tell us maybe about some of the behavior, some of the leadership maybe more broadly that we could then see in the coming quarters?
Yeah, the beats have been rewarded, and I stress the on average part because especially within this earnings season, there's a huge range between, the companies that even if you are beating, some of them are not faring as well, especially if they're not beating on the sales side and if they're not having guidance that's relatively strong. So I think that's probably more important. But even within some of the sectors, and even though we talked about staples outperforming, that's actually been one of the worst sectors so far for companies that are actually missing, whether it comes to earnings or sales, because that's a sector that's been really under pressure from pricing power. And especially with this level shift in inflation now having largely played out, we're still positive year over year and we're still positive month over month for inflation metrics, but it's not as extreme as it once was. And we know that consumers have continued to sort of trade down and be a little bit more selective when it comes to where they're putting their money. So I think you have to be maybe a little bit more granular when it comes to sector by sector or even company by company, because you can get great beats even in the tech world. A lot of the mega caps that reported, over the past couple of weeks, you can get some really solid data. But if there's a miss maybe on CapEx where they're spending too much, or if there's a miss on what the guidance looks like, then you can kind of get into some trouble, especially when a sector like that has become so highly correlated with the momentum factor this year. Any unwind that you get in that factor tends to accelerate to the downside, and it becomes fairly emphasized to a pretty significant degree. And of course, that's what we've been seeing.
I hope you had your best ginger tea on deck this week because you certainly needed it. Kevin Gordon,
Yes.
Charles Schwab, Director and Senior Investment Strategist. Thanks so much for taking the time.
Thanks,
here with us
guys.
in
Good to
studio.
see you.
Good to see you too. Coming up, everyone, the state of streaming. Shares of Warner Brothers Discovery sinking on the back of its earnings here. We'll have analyst reaction on the other side of this break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market domination. Tune in daily from 3 to 4 p.m. Eastern.
Shares of Warner Brothers Discovery are sinking on the company's disappointing results. The streaming giant took a massive $9 billion impairments charge related to its TV networks unit. Now, for a deeper dive into the results, we're joined by Robert Fishman, MoffettNathanson's senior analyst here. Great to have you here. Just want to get your read in on the report from Warner Brothers Discovery and how investors should be kind of keeping the context around this name alive, or at least in their thesis.
Sure. Good morning, and thank you for having me. The print last night was not a great print, to say the least. Basically, the challenges continue, and linear television is still the biggest driver of this company's profit. And as we all know, that the pressure on the ecosystem, given cord cutting, given U.S. linear advertising challenges, is weighing on the company, and given the leverage that they have with the elevated level of debt, that becomes an even more difficult situation to be in.
So Robert, then what does that tell us about where Warner Brothers is headed from here? Because I do think there might have been split reaction. I don't know if it's fair to say that. Yes, there were many concerned about what was in this report, but there also seemed to be some optimism just about the recovery in the studios business. Was that maybe able to offset some of that concern that we did see in the ugliness of this quarter?
Yeah, listen, I think that there's a few big questions that still need to be answered for the future of this company. You got to start with what's going on with the NBA front and center. There's lots of potential implications if they do end up losing. They're in the middle of a court case right now in terms of their matching rights. So if they end up losing that case or dropping the case and moving forward without the NBA, it brings up a lot of questions to your point about what the future of this company looks like in terms of their linear affiliate fee negotiations. Clearly, they're doing a lot to try to capture as much sports rights out there from others to help offset the potential loss of the NBA. But in our opinion, it's still not likely to be enough. So there will be pressure on future affiliate fee negotiations that come up as early as the end of this year or into next year for the Turner portfolio. Discovery's at the end of this year. So we'll see how widely this does become a negative for the company in terms of the future negotiations. But to your studio point, that is a real potential upside. It is a hit and miss business, as we all know. And when the movies are coming in and doing well, that's a great thing, like they had with Barbie last year. But when you have misses, as they have recently, and the video games have not gone as well as last year, so there's a lot of different moving pieces within this studio line. The upside potential in the second half of the year is going to be the return of the television studio and licensing after the strikes. So again, lots of different questions, lots of different moving pieces here.
Robert, going back to what you just said a minute ago about the loss of the NBA rights and the pressure maybe that's going to add to, or going to put on ad and affiliate revenue, have you modeled that out? I guess how big of an overhang maybe could this be for Warner Brothers, at least in the short term?
So in the short term, they're pretty locked in through 24. So we're not going to see that in the next couple of quarters. The question is what happens when they negotiate, as I mentioned, the Discovery portfolio at the end of this year, if that's able to stay separate and not get impacted if they've lost the NBA by then all eyes will turn to the Turner negotiations, and they have some bigger deals coming in 25. So short term, that they're still largely protected. The bigger concern in the short term is going to be that U.S. linear television impact. And we've seen, I think, now 8 quarters of double-digit declines. So it's again, unfortunately, not a very pretty picture on the advertising front. And then on the affiliate fee front, we're going to still have to wait to see where these deals end up and how negative it could end up being. But it also is dependent on what other sports rights they're able to capture.
Yeah, Rob, I was looking at some of your analysis and the comparison of time spent on streaming and direct-to-consumer content platforms, all of them compared to Netflix, and how many of them are lagging, and it's not even close here. So is there a clear vertical within direct-to-consumer or genre that you expect Warner Brothers Discovery to lean into that could help them close that gap a little bit?
Yeah, it's a really interesting question. Clearly, as part of Max, which used to be known as HBO Max and known as other iterations over many years, but we're down to Max now. The key question that you're alluding to is HBO content, as you're showing here, is still the premium content, the premium driver for Max, as House of the Dragons is going on, right? That's going to capture new eyeballs, new users, new signups. So HBO is still going to be the leading driver of Max. They put it together with the Discovery portfolio, but unfortunately, it still hasn't really completely expanded to a broader audience. So you bring up the question, what else can they do? And to us, I think that there's going to be an openness or at least look to explore potential licensing deals. Obviously, Paramount, and given the uncertainty there, what we might learn a little bit more after market close today with their earnings. But if Paramount's open to licensing some of their content, you would expect Max to at least explore that. The other way Max and Warner Brothers Discovery is approaching this question is by bundling with other streaming services. So they just recently launched a bundled package with Max and Disney Plus and Hulu.
All right, I guess we're all just waiting for the next White Lotus season to come about then, Robert?
Next year.
All right, I'll be watching it. We'll have our own think pieces on it.
Still haven't seen
Good
that.
stuff. Thanks.
What?
guys.
I know. I gotta jump on the bandwagon. Haven't watched it yet. All right, Robert, great to have you. Robert Fishman, MoffettNathanson, senior analyst. Thanks so much.
Thank you.
Well, Bitcoin is regaining some of its losses after Wednesday's volatile trading session. You're now looking at gains of just about 0.5%, but it's back above 57,000. Jared Blicker has been closely tracking the movement that we've been seeing this week in crypto, Jared.
Yes, Bitcoin got swept up in the risk off, risk on, daily fluctuations along with everything else. Here we see Bitcoin is up 0.5%. And what you're looking at here is the last 10 days. And here is that steep decline. Looks like a capitulation low. A lot of times you have a retest of it. So not necessarily seeing that just yet, but just throwing out possibilities. Just spending a little bit of time on the technicals here. We are in a short-term or to medium-term downtrend. You see these lower highs and lower lows, but on a 5-year chart, it's just a little flag there. And the trend on the longer term is still up. So we're just looking and searching for direction here in the short to medium term. Long term, we'll have to see. But 60,000 is a big level to me. If Bitcoin can reclaim 60,000, then it has another shot at its record highs around 73,000. And from there, we know the sky's the limit. We did get some interesting news on court cases today. Over in Bitcoin, Alameda Research and FTX ordered to pay over $12 million by a judge. But you'll notice here, I'm looking at Ripple. This is a separate court case. The SEC had sued Ripple, and there's just a settlement announced for $125 million, or excuse me, a judgment for $125 million. The SEC is expected to appeal, so it looks like this is not over, but this chapter is over. So here's a 5-year chart, and I'll just bring this down to a year to date so you can see got that nice little spike up here, but still basically underwater for the year, down about 4%. Just looking at the crypto space in general, I want to show you an equal weighted so you can see how the winners and losers shake out. Pretty evenly matched here, not looking particularly bullish or bearish. But when I put the 10-day on, you can see that there's a lot of red to be worked off here, guys.
Jared, thanks so much. Keeping tabs on all things crypto right now. Also coming up on the other side of this short break, Bumble shares are plunging. We discuss why and what other tickers are trending on Yahoo Finance. We've got that for you right after the break. You're watching The Morning Brief, and we're taking a closer look at what's trending on Yahoo Finance. And those are, get it, Bumble, Krispy Kreme, oh yes, and Robinhood. Let's start things off with Bumble shares. They are plunging after slashing its full-year revenue outlook. The company now expecting a gain of 1 to 2% in its revenue, in its 2024 revenue. That's down from the previous expectation of growth of as much as 11%. Take a look at these shares right now. They're down by 38% here on the day, and just looking at where that compares to how they've performed on the year-to-date scale here, that should be a new year-to-date or 52-week low for the company and for the stock, at least right now.
All right, let's take a look at Krispy Kreme. Those shares are rising. People are loving their donuts. The donut chain's expansion efforts in the U.S. and also abroad, pushing sales to the upside in the second quarter. The company lowering, though, its full-year guidance to reflect the sale of its majority stake in Insomnia Cookies, its cookie delivery arm. Despite that, though, you're still looking at gains of just about 14%. The company also went on to say that their innovative specialty donut collections are continuing to resonate with consumers and drove the increase. DFD delivered fresh daily and digital sales in the quarter. Like I mentioned, their revenue coming in better than expected. Total revenue was up just about 7% from a year ago. When you take a look at the U.S. specifically, sales there up 8%.
You guys laugh at me when I circulate my Krispy Kreme stories, but you'll find out. It's an economic indicator here. You do. All right. Robinhood shares, we're also tracking that here today. It was up after earnings. Right now, just barely holding on to some gains of about 0.2%. As you see there on the screen, we did see a touch negative territory. Here's what's happening. Revenue from the cryptocurrency and options trading driving its second quarter revenue surge. And it's also seeing a rise of customers sign up for new products like its credit card and subscription services. Hey, guess what? We'll also be diving deeper into this report with the Robinhood CEO, Vlad Tenev, in the show Wealth at 11 a.m. You do not want to miss that. All right, they told me to wrap, so you'll have to stay tuned for that interview.
11 a.m. Eastern time. Looking forward to that interview. I'll keep it right here because between that time, we've got Catalyst. We're going to take a look at the gains that we're seeing across the board in the markets. Again, looking at the major averages. You're looking at green across your screen. You now got the Dow up. Look at that, 440 points. The NASDAQ also up just over 1%, as well as the S&P 500. That moved to the upside off the back of better than expected labor market data, claims coming in just lower than what the street was expecting. We'll discuss how long we can expect the rise to last in the markets. That's the big question everyone's asking. That's coming up next on Catalyst. Just after 10 a.m. here in New York City, I'm Shauna Smith alongside Madison Mills. And let's dive into the catalyst moving markets today.
Starting with the labor market here, a beat on initial jobless claims coming in just below estimates. The right kind of downside surprise in this case. That is a sign of less pain in the labor market. Fewer people than expected filing for unemployment. Stocks are moving higher as investors breathing a sigh of relief about the labor market. We'll discuss how to position your portfolio amid the volatility.
And Nvidia moving to the upside on the back of yesterday's 5% drop. It's still one of the biggest laggards, though, in the Mag 7 this week. We're going to talk to an analyst about why he says now is the time to buy the chip stock.
And as earnings season continues, Barclays changing its rating on the retail sector. We'll tell you which stocks one analyst sees as buying opportunities within this space. But first, our big story. Let's take a look at where stocks are trading about 30 minutes into your trading day. You're still looking at gains across the board here. The S&P 500 up over 1% and the NASDAQ up over 1% as well. Now, this is coming again off of that better than expected jobless claims print, easing some of the recession fears that were sparked by rising unemployment in Friday's jobs report. Joining us now to discuss, we've got Jason Pride, a senior investment strategist at Glenmead. Jason, thanks so much for being here. I want to pull up a chart, if we can, from our control room that just takes a look at the velocity of sell-offs over the course of the past century here. And you can see that yellow bar on your screen here is right where we've been the past couple of days. And I was a little bit surprised, frankly, that our sell-off that we've seen over the past 5 days here was not less of a big deal in comparison with history. So my question to you is, to what extent do you see this sell-off continuing and therefore becoming an even more historic moment?
Look, I think we are probably a little bit hesitant to say that this sell-off is going to continue at near the same speed. We had a confluence of events that happened all at the same time. We had a little bit of an economic surprise that people are still, I think, deciphering that employment report. I mean, even today with the jobless claims numbers, people are kind of looking back and questioning, well, how do you reconcile these two? But really what you had on top of it is you had the Bank of Japan starting a rate hike cycle, or officially like kind of heading that direction, that kicking off a currency movement, which kicked off some forced selling for people in a carry trade position using yen as a funding source. And those things together are kind of like other previous big, really rapid declines, just kind of happened at the same time and kicked off a series of dislocations in the market that probably will eventually turn out to be, when we look back, as temporary in nature in terms of the pressures on the market. There's still going to be some recalibration on the economic front for people, but the market shifts were very kind of pressured in that moment.
Jason, as that volatility hasn't fully worked its way through the market, it doesn't seem to have. So I guess maybe what does that then tell us about that expected volatility, or maybe some of the future losses that we could see as a result?
Sure. One thing that we'd like to say is corrections like this, 5, 10% or 5% plus corrections, they occur on average at least once a year, sometimes 2, 3 times, sometimes more. This is actually not that unusual, particularly if you think about what the market's been through. We were up 15% plus through June for the S&P 500. So to see a 5% pullback on a 15% up year in just the first half, it actually feels a little bit, from our perspective, a little bit healthy in nature. It resets valuations at a more kind of stable basis. Now, kind of to your question of what does that mean on a go-forward basis, we're probably still going to be picking through this economic information. We are likely in a little bit of a slowdown from an economic and profit standpoint heading into the back part of this year. Our models are basically saying this is not a guaranteed or high likelihood recession, even with some of the unemployment numbers. We still think we're going to be in expansion mode, but it's probably going to be a little bit softer. And people are going to be trying to decipher that in the back half of this year. I think it takes some time for us to see enough economic data for people to get comfortable with the fact that, okay, this isn't a recessionary environment yet.
Can AI continue to drive the market gains for the second half of this year, or is this moment a sea change?
Mazza, I think we talked about this last time I was on a while back. We are advocates and very positive on the longer term outcomes of innovation cycles, and AI being what we think is one of the bigger innovation cycles that we have seen. But at the same time, historically, we've seen a pattern of hype followed by disappointment when things just don't come through and be realized on a fast enough basis as markets often expect them to be, followed by an eventual cycle of realization that's kind of further out in time. We think we're probably going to be going through that cycle. It seems like the information coming out and kind of the nitpicking of the AI is starting to inch in that direction of disappointment, where people are looking and saying, well, wait a second, how much money have we spent on this? And when are we actually supposed to get associated revenues or profits with all this capital spending? It's not unusual for the stock market to be a little bit short-minded and look at it and say, we don't like getting paid back 3 years from now for something that we spent today. We like to see profits now from things we spent now. It's not like the venture capital world. This is the stock market. It tends to reward instant gratification.
So then, Jason, what does that then further tell us about how investors should be positioned? Is it time to get a little bit more defensive, at least here over the coming weeks and coming months?
I think it really depends on your starting point. That's a really important perspective. Every client or every investor should have an idea of like, what's my normal? What is my kind of neutral allocation on equities and bonds on different portions of the market? And then the thing that you should be doing when you have volatility like this is rebalance, don't chase. Meaning when the market's up a lot, don't chase the market up a lot. When the market's down a lot, don't chase the market down a lot. Use the volatility to rebalance your portfolio. You actually move in the opposite direction of big market moves. That's what we're advocating investors do at this point in time. That rebalancing can be slow. It doesn't have to be like every single day that the market's down, but use it as opportunities to rebalance, get yourself on target with your investment approaches, and that'll be the better longer term strategy in an environment that's like this with this sort of volatility and risk.
All right, Jason Pride, always great to get your insight. Thanks so much for coming on with us here this morning.
Thank you, Sean.
Senior investment strategist at Glenmead. Thanks, Jason. Nvidia shares recovering today after closing down 5% on Wednesday. The chip giant has lost $900 billion since its all-time high back in June. This comes as earnings for some of Nvidia's biggest customers, those large cap tech names, have been a bit mixed. Our next guest, though, seeing some opportunity, saying that the volatility represents a reason to buy. Joining us now, we want to bring in Antoine Chkaiban. He is a technology infrastructure analyst at New Street Research. Antoine, it's great to have you here. So it looks like you recently upgraded Nvidia to a buy. You've got a $120 price target on the stock. And this comes at a time when it seems like many investors are still waiting on the sidelines when it comes to Nvidia. What makes you bullish at this point?
Thanks, Sean and Matthew, for having me. So, yes, I would say that, first of all, since the peak of June, Nvidia's stock has pulled back by nearly 30%. So that's underperforming most other semiconductor stocks that are exposed to data center AI. And the reality is that, even despite the concerns, the recent concerns on the company, the Blackwell delay, concerns around macro, we still expect Nvidia to dominate the data center XPU market. And we see in-house XPUs doing well as well, like companies like Amazon, Google are developing their own in-house XPUs. We also see alternatives to NVIDIA GPUs like AMD's GPUs also ramping, but we expect NVIDIA to remain dominant in a market that is growing very, very fast. And so I would say that we see little downside to expectations for NVIDIA's data center revenues. We see little downside to valuation, even the stock is now trading below the trough multiple of the 2018-2019 down cycle. And so that makes it a very good investment at the moment.
I want to talk about what we've heard from some of NVIDIA's biggest customers, as Shauna was mentioning. You've got Microsoft, Meta, Alphabet, and Amazon contributing about 40% of NVIDIA's overall revenue, and that's according to Bloomberg estimates. If Wall Street was frustrated by the AI ROI story that we heard from those four big tech names that I mentioned, couldn't that hurt NVIDIA too?
Yes, so I think the right way to look at it, so yes, you mentioned 40% of total revenues. NVIDIA actually also discloses, that the large cloud service providers represent, about half of their data center sales. If you look at how much CapEx for the top four hyperscalers is set to grow this year and next year, and you unpack that, between investments in AI, investments in traditional infrastructure, well, it's true that we still need to see a bit further revisions to what consensus is expecting for capex growth next year to make room for Nvidia to be able to meet expectations, but not that much revisions, maybe 10, 15% actually. Yes, of course, whether capex can keep growing at such a pace beyond 2025 is a question mark. It will depend on the pace of adoption of generative AI-powered use cases. It will depend on the monetization of all the investments made over 2023, 2025. But reality is that even if we conservatively model a significant slowdown in investments in 2026, 2027 by these giants, that still makes room for good upside for all the names we cover exposed to data center AI spending. And so that's Nvidia, of course, but also AMD, Broadcom, Arista, TSMC, Micron, and the list goes on.
Antoine, I'm curious something that you just mentioned a moment ago, and that was the fact that you're not too worried about the reports of Blackwell delays. I guess I'm curious as to why. Why is it that you see that as a limited setback at this point?
So yeah, just to put a bit of context, the Blackwell is a chip that's designed with CoWoS-L. It's a packaging technology by TSMC that is being used in Blackwell. That's different from what was used in Hopper, where it was CoWoS-S. And so that involves like high density local silicon interconnects and redistribution layers to improve the die-to-die interconnect density so that the two dies can speak to each other very, very quickly, very, very fast. And so the integration of these components into the substrate has resulted in issues like thermal mismatch and warpage. But reality is that Blackwell is a cutting-edge chip. It's pushing the boundaries of packaging. And it was brought to market very, very rapidly by Nvidia. Nvidia is accelerating its product cadence. So inherently, there were risks of delay. But that being said, we still expect Nvidia and TSMC to bring Blackwell to market with acceptable yield and volume in 2025. And in the near term, Nvidia can mitigate the situation in many ways. They can extend the life of Hopper. They can release a single die Blackwell chip. And so, yes, maybe the shipments will be more weighted towards Hopper in the second half of 2024 and early 2025. But we still sense enormous and urgent demand across the board, and that mitigates the risk of opposing shipments as customers wait for the next generation of chips to be available in volumes.
In our final minute here, how big of a risk is the potential economic slowdown that we're hearing teased out? I mean, JP Morgan this morning not only raising their likelihood of a recession this year, but also raising their recession likelihood to 45% chance in 2025. To what extent does that macro concern impact your view on Nvidia specifically?
So I think that for 2025, you can, things are fairly well set. You can look at things from multiple angles. We talked about the hyperscalers CapEx earlier. We know roughly how much they expect to grow CapEx. Plans are already set, they already have a plan to train, the next generation of GPT models and the next generation of Gemini models. I think here there's probably limited room for much changes in plans. You can also look at the supply front, and we know that CoWoS capacity, that high bandwidth memory capacity is going to make room for Nvidia to meet expectations. So I think 2025 is fairly well set. Now, yes, if we enter a recession, if the macro deteriorates, what happens beyond 2025 is still a big question mark, and we could end up in an AI winter. We could end up in a pause in investments, and that, of course, remains a risk.
An AI winter that could come with a recession, but sounds like you're definitely not pricing that in for now, as you still think Nvidia is a buy. Antoine, thank you so much for joining us and breaking that down for our audience. That was Antoine Chkaiban, a technology infrastructure analyst with New Street Research, joining us on Nvidia. Now, concerns about the economy are not only raising questions about those chip names like Nvidia, but also the broader AI trade that's driven a majority of the market gains year to date. And this comes after Magnificent Seven members, including Amazon, Microsoft, and Alphabet, all saw downside moves after their latest quarterly results. Here with why the AI trade is losing steam, we've got our very own Dan Howley. Dan, what do you got for us?
Yeah, Maddie, there's three real issues going on here with the AI trade overall, and I'm going to break them down really quickly. The first is that there's not a lot of transparency when it comes to the software companies and how much revenue they're seeing from AI, if any yet. So far, we just hear about their cloud businesses, what their cloud businesses are doing, and then they'll say something about how AI is offering some kind of revenue in there. Microsoft goes the furthest so far. They'll tell us what percentage of growth AI has provided. So, for instance, in the most recent quarter, they said it provided 8 percentage points to Azure growth. The prior quarter, 7 percentage points. So they're providing that, but we don't know how much Azure actually makes on its own. We know how much the Intelligent Cloud and Azure make, but not just Azure. So it's still a little opaque as to how much AI is actually contributing to companies' bottom line. The other thing is the AI software side is just moving too fast. Some of the experts I spoke to who are talking to different companies said, look, every other day it feels like a new technology comes out or a new model comes out, and that's hurting companies because they're trying to figure out if they want to install the software or use the software. And as new models come out and new features come out, they have to figure out how those fit into their own businesses. So that's another issue. And I think, honestly, that the final issue is that when it comes to hardware versus software, there's a fundamental difference. The software needs the hardware to work. So while they're building out this software, it needs that hardware part. So you're going to see a lot of the hardware money come in first. That's why we're seeing Nvidia do so well, or we've seen Nvidia do so well, because the software companies need their chips to actually build the software that's going to power this next generation of growth. The software side is going to take a little bit longer, and so that's what's going on now. Sure, they have models, sure, they have ideas, but they have to put those into real products, and that's taking some time. So it could be about 3 to 5 years. Some say a little longer, but that's really the main problem here.
All right, Dan, thank you so much for breaking that down for us. And we'll all certainly be waiting for those Nvidia earnings to come up in just a couple weeks to determine how that AI trade is going moving forward. Now, we've also got another big day for Eli Lilly after their earnings print. Shares of the pharmaceutical giant up over 8%, nearly 8.5%, as weight loss drugs continue to show strong demand for the firm. We've got analyst reaction to that when we come back.
Eli Lilly shares are moving to the upside here. You're taking a look at gains of just about 8%. The move here to the upside comes as sales of its diabetes drug Mounjaro and also its weight loss drug Zepbound surged. The company blew past analyst expectations in its second quarter. It also raised its full-year revenue outlook. Here for a deeper dive into these results, we want to bring in Jared Holtz. He is Mizuho's healthcare equity strategist. Jared, lots to talk about here within this report, but at least on the surface, or really what's driving the action, is a lot of the excitement surrounding the weight loss drugs. Of course, one of the questions going into this print was the ability to meet demand. I guess now that we're getting maybe a clearer picture following the earnings report and also the call about what exactly the ability to maybe meet that supply constraint could be here in the second half, how big of a catalyst then do you see this being for the stock going forward?
Thanks so much for having me. Yeah, it's a major catalyst in terms of, the company's ability to get capacity at the point where they can meet the demand that's obviously out there in the market. It's kind of amazing when you look at the numbers that Eli Lilly is already generating in just the second full quarter of Zepbound being on the market. It's already annualizing basically at $5 billion, and we haven't even scratched the surface with respect to Europe and other geographies out of the US. So as soon as capacity kind of starts rolling here, I think you're going to see a lot of upside to numbers for the next few years.
And I'm curious too, Jared, because Novo Nordisk was first to market with weight loss drugs back in 2021, and then you had Eli Lilly coming along after the fact, but then moving ahead of Novo Nordisk, as we've seen in the latest earnings prints. What do you attribute that to?
I think it's just the amount of excitement there is in the market. We've seen so many clinical studies, not only showing how profound the weight loss is for these drugs, but that they're kind of preventative medicines in some respect, with cardiovascular benefits, with stroke benefit, heart failure, kidney failure, all these other medical conditions that the drug is very active in reducing. So we always talk about, drugs that are used once patients have already been diagnosed with something. In this case, they're preventative in many ways. Plus, you get, 15 to 20% weight loss in less than a year. I just feel like so much more of the population is interested in this beyond just obesity. So I think those are the factors there.
It's interesting. I know that there are so many competitors in the space, and one that I'm looking at in particular is Hims & Hers, which is selling a compounded version of the drug. There are several out there. I feel like you can't really open Instagram these days without seeing several of them. To what extent is that a potential headwind for a stock like Eli Lilly?
It's already been a little bit of a headwind just from a narrative standpoint. Some of the compounders have been able to find success here early on because of the supply issues at Novo and Lilly. But now that they've both kind of allocated over $20 billion of funding into manufacturing just this year and will continue to do so, I think it limits the ability of the compounders to have kind of like elongated success in this market. I mean, most patients want the branded products, no doubt about it. These auto injectors are very easy to use. They take a couple seconds, when you use them as injections. That's versus the compounded product that's in a vial with a normal syringe. So I think for most patients, they want the branded product. The inability to get it has been the gating factor. So I would think Hims & Hers in this department, while still being a pretty good growth driver, is not that meaningful at the end of the day for either company.
Jared, I want to switch gears here just a bit, stick with obviously the pharma sector, and talk about what we're seeing in Novavax today, because we're seeing a huge move following their earnings report. You're looking at shares really moving to the downside. The company slashing its revenue forecast, and actually now we're looking at gains of just about 2%, so a bit of a reversal there. I'm curious, and this is a stock that tends to be extremely volatile following the earnings reports that we are getting, but I'm curious, there's a lot riding obviously just in terms of what demand is going to look like for the vaccine, whether or not they're going to see that updated shot here for the fall season, and what that is ultimately going to look like on a global scale as well. What do you see the future looking like here for Novavax amidst all of that uncertainty?
Yeah, for sure. This is a super volatile stock. Not that surprised that it's up today when you just look at the valuation of a company that's worth a little bit more than $1 billion and is still going to do roughly 400 to 500 million in sales next year with the vaccine, you're not looking at a huge multiple. But when you kind of like zoom out here, this COVID market for vaccines, I think, is going to be incredibly disappointing, not only this year, but in the out years, barring some unforeseen pickup in a very severe strain of the virus, which has not really happened in some time now. We're 4 years away from peak pandemic levels. We've really not seen anything overly discouraging or concerning relating to the virus in a number of years. I just think the population is kind of vaccinated out. I've been saying that for a while. I do think there's a faction of the population that wants this extra protection every year. The elderly, people with a lot of comorbidities that are very, very kind of paranoid about what getting COVID again could do. But I feel like we're in the midst of just a market in perpetual decline. So for Novavax, that has a low revenue base, it's a little bit different because, again, as a $1.2 billion company, you can kind of make the numbers work. But broadly speaking, I just feel like COVID vaccines, as we know them, are going to decline for a number of years.
All right, Jared. Well, thank you so much for breaking that down for us. It sounds like the firms that have transitioned over to weight loss drugs from those vaccines certainly having better earnings prints, at least this cycle. Thank you so much. That was Jared Holtz. He's Mizuho's healthcare equities strategist. Let's move on to some of our trending tickers, starting out with Dutch Bros. Those shares plunging down over 25% after its forward guidance came in below expectations. Yahoo Finance's senior reporter Brooke De Palma has the breakdown for us on set. And Brooke, I thought of you immediately with this because you did such a deep dive into Dutch Bros and the company, talking to so many people within the firm for months. What did you expect heading into earnings, and what can you tell us about this print and why it is so negative for them?
Yeah, well, let's be clear. It was a solid quarter. We did see same-store sales growth up 4%, but after such momentum for the company, some even comparing it to be the next Starbucks, that forward guidance was a disappointment for the street here. And as you could see, that's translating into shares down roughly 25% this morning. Now, forward guidance, two areas that investors are really focusing on is that sales growth outlook and unit growth outlook. The company reiterated same-store sales growth, same shop sales growth it calls. It's expected to remain in the low single digits. And Wall Street was really hoping for more after seeing 10% sales growth, now 4%. Wall Street sort of saying, hey, in the second half, are you not going to see that momentum? Bank of America analyst Sarah Senatori calling it highly conservative. And there's three factors that really drove Dutch Bros' decision to reiterate that same-store sales guidance. That includes the roll-off of price increases in Q3. That's going to be roughly 4%, in addition to year-over-year increase in promotional activity, and really this uncertain macro environment that we're seeing. Now, the other factor here that investors are really focusing in is that total system shop openings in 2024 are now expected to be at the lower end of the previously communicated range of 150 to 165. The reason behind that is the company did remove sites from its pipeline that were set to open this year that they say didn't meet new objectives it has now set for their real estate strategy moving forward. The company does still anticipate 4,000 shops in the next 10 to 15 years, and Wall Street saying here that they view this as a one-time adjustment and expect growth to reaccelerate next year. Now, other drivers include mobile order, paid advertising, innovation, and digital offerings. Those are some key growth drivers that Wall Street is really looking to pick back up momentum in this later half of this year, in this environment where consumers are really nickel and diming, I guess you could say.
Yeah, we're certainly seeing that impacting one of their big competitors, which is the Starbucks of it all. So really interesting points there, Brooke. Thank you so much for joining us. Appreciate it. Looking at another trending ticker for us, shares of Datadog rising after reporting a second quarter earnings beat. The stock is up over 5% right now. Now, the cybersecurity firm also raised its full year forecast. And just to run through a couple of the headline numbers here and just the degree to which we are seeing beats, revenue coming in at $645 million. That's a 27% upgrade year over year. Cash and cash equivalents up over 40%. Adjusted gross margin coming in at 82%. 82% versus 81%. Now, what's interesting to me is that this is a SaaS, software as a service platform, and this is going to give us potentially an indication of the broader business community's health because they would utilize Datadog as a service. And it's interesting to see that they talk about customer additions coming in a little bit softer than anticipated. That's really one of the only pieces of softness that you can point to in this print, and that is indicative to me of potentially a broader business environment that is starting to pull back just a little bit on some of their quarterly expenditures.
Yeah, the report, I think also just saying that it signals some of that, it signals there will be little AI-led boost here for the near term. And I think that also speaks maybe more broadly to some of the trends that we've seen play out here in the markets. But you're right, overall, this is a very strong report. Why we're seeing that stock up just about 5%. Yes, the fact that we did see a bit of a moderation in customer additions, that may be obviously something that the street could take issue with down the line if it becomes more of a trend that we're starting to see. But overall, at least taking a look at the street's immediate reaction to this, Baird saying that this is a solid report here. That outlook implies 20% revenue growth here going forward at the midpoint, which they expect, again, to prove conservative. So again, they even think that this massive, growth that they are expecting to see, maybe even still on the conservative side when you take into account some of the trends that we're seeing underneath the surface. But Datadog, again, bucking some of that downward trend and some of that downward pressure that we had seen more broadly across the space. And we're seeing that move to the upside again today, up just about 5%. Well, coming up, a bearish call on the retail sector slightly. Barclays warning that a promotional environment could suggest weakening demand. We're going to speak with the analyst behind that call next.
Barclays coming in with a downgrade to the retail sector to neutral from positive. The firm citing intensifying promotional activity as one of the reasons behind the call, saying it could be pointing to a weakening demand backdrop. Adrienne Yee joins us now. She's Barclays Consumer Discretionary Senior Analyst. Adrienne, it's always great to speak with you. Talk to me about how much the macro environment specifically is driving this call, because I think that is one of the bigger concerns for our audience more broadly, is just the degree to which we are seeing the macro question of softening showing up in company-specific news. How much did that drive this view?
I think it's about 80% of this view. What I would say is, if you recall, last year it was all about cleaning up the inventory. And so there were a ton of promotions last year, and rightfully so, right? Because these companies were trying to get rid of that inventory. We are seeing the same level of promoting now that the companies have clean inventory. So what that basically means is they're doing it for an entirely different reason. They're doing it to drive and stimulate traffic and conversion. And that's clearly an indication that the consumer is very choiceful and pulling back.
Is this going to be a trend that you see sticking with retail, or something that retail is going to see now for quite some time? And then the ability to navigate that, how challenging is it given the macro pressure?
Yeah, so whenever there's an ebbing tide or a rising tide, we always go with the 80-20 rule. 80% of companies, right, they live in that kind of sphere of what is actually going on, kind of in the broader economy. There will always be 20% of companies who it's their brand moment. We've talked about the denim shift benefiting a Gap or an Eagle or an Urban, Skechers and Deckers and On, right? They all have brand momentum. So I named like 7 companies out of maybe like 40 that we cover, right? DKS is another one that's going to benefit from kind of all, selling all of the hot brands. So it's a very choiceful kind of consumer landscape. By the way, the consumer's not unhealthy at all, like the macro. We are at record lows of unemployment. And what's actually happening is this inflation is just so insidious. It's just eating into the kind of mental, that negative wealth effect. And that's what causes people to pull back on spending.
Adrienne, let's talk about the denim of it all, because I'm just fascinated by this. As you just noted, you've got American Eagle, Gap, and Urban benefiting from the shift in denim silhouettes. If we didn't have this cycle that I feel is primarily driven by TikTok that made us shift through trends so frequently, would these still be among your top picks of retailers?
This is what I would say broadly, that is a trend that can buck the broader, weakening consumer malaise is sort of, the new news. So what I would say is we would be looking for companies that are structurally improving, but I think that you would see far fewer names in our roster of things that you want to own. It is really, really hard to kind of pick that bottom when the overarching kind of, demand environment is getting weaker.
Adrienne, I want to bring up Nike because it's one of the names that you've recently downgraded to equal weight back at the end of June. I'm curious, as we look ahead, we're not going to hear from the company for several weeks in terms of their earnings report, but some of the challenges that they have faced, whether it's the product pipeline, whether or not they're no longer registering with consumers, what is it that Nike needs to do in order to really implement that turnaround story?
I think with Nike, I think the frustration that we had, with kind of I would say kind of the thesis that we had is that each quarter it would seem that we were coming into the earnings with what we thought was the company's sort of 1 to 2 year strategy, right? What we found out, at one point it was to go to DTC from wholesale, then it was to go back to wholesale, then it was to franchise manage in the most recent quarter, meaning that they are going to hold back product from the DTC channel. So it's very hard for, us on the outside to analyze a constantly kind of moving target. And so I do think they can make the next couple of quarters. They gave, 10% operating margin guidance was down 10% sales. So there's no real kind of risk to the numbers. But at the end of the day, it's a growth company. It is valued like a growth company. They have to grow the top line. And when you think about the proof point, right, of all this innovation, it's going to come sort of mid-year 25. And we weren't willing to kind of be that patient with it at this point in time.
All right, Adrienne Yee, she's Barclays Consumer Discretionary Senior Analyst. Thanks so much for joining us here.
Thanks for having me.
Turning to a trending story here today, Costco, it's cracking down. And before you head to the store, you'll want to make sure you have your membership card with you. The retail giant is installing membership scanning devices at the entrance of stores, so shoppers will have to verify that they are members before entering. It's not doing much for the stock, at least in terms of any concern. Maybe people wouldn't be shopping there as frequently. There'd be maybe some of a pushback. Shares are actually moving to the upside today, so maybe this is a sign that, hey, people aren't too frustrated with this update. But again, this is a trending story here, Maddie, at Yahoo Finance. And I bring this up, one, just because of the popularity of Costco, two, because so many people are more on the hunt for deals, for value, something similar. We were just talking to Barclays retail analyst Adrienne Yee about moments ago. And I also wonder what this is going to do to membership numbers. If a crackdown like this is ultimately going to boost membership numbers at a time when Costco is raising its membership prices slightly.
It's such a great point, Shauna, but also I'm fascinated in Costco as the latest company to come out against freeloaders, essentially. I have certainly been guilty of joining a friend to get into Costco, and you can still do that so long as your friend has their pass and they badge in. That was the first thing that I checked in terms of the me of it all impact of this particular story. But it kind of reminds me of the price hikes and the password crackdowns, password sharing crackdown rather, that we are seeing from some of the streamers. Netflix came to mind for me, for example, when this story came up. It seems like as we continue to see companies having to find kind of creative ways to increase their pricing power, to up their margins every quarter after quarter, the thing that they're turning to is cracking down on some of the freeloading activity that we are seeing. In particular with Costco, I also think that part of it is the ability for consumers to maybe find a card that's been used by someone else. Perhaps there's some stealing involved with that. They do note that in particular, they are wanting to make sure that each customer coming through the door has a card that matches their identification. That's why you'll have to have a photo ID with you for that. But I find it to be a fascinating trend that we're seeing across several companies here.
It certainly is. And if you're asking maybe why this could be a catalyst for the stock, remember that the bulk of Costco's profits come from their annual fees. So this is why this is so critical and something that the street closely watches, and also why, what was it, just a few weeks ago, maybe a month or two ago at this point? It's hard to keep track, but Costco recently raising, I believe is the last earnings report, raising the membership fee by $5 to $65 in the US and Canada. It was the first time they did that since 2017, and that is set to go into effect on September 1st. All right, keep right here on Yahoo Finance. We got much more of your market action ahead. You're watching Catalysts. Record spike in the VIX rocked Wall Street this week. The volatility index, known as the fear gauge, recorded its biggest one-day jump on record, closing at the highest level that we've seen since October 2020. The catalyst? Rising recession fears and a massive unwind of short positions. More than $4 billion was erased from 10 of the largest short volatility ETFs from their highs. We want to bring in volatility expert Jim Carroll. He's a senior wealth advisor and portfolio manager at BelastRock. Jim, it's great to have you here. So talk to us about the moves that we've seen, specifically in the VIX over the last several trading days. We had the massive spike to start the week. Here we are today, right around 24. Is this maybe comforting? Should investors be looking at the massive pullback that we have seen as maybe a telltale sign that things are going to calm down or on the cusp of coming down shortly?
Well, I think first we have to look at the shock that happened really prior to the opening on Monday when we got up near 66 for the VIX, because that was a bit of an aberration. All of my acquaintances inside the options world are telling me that things went haywire Monday morning before the open, and that print was outside of any reasonable expectation, and you could see that in what the VIX futures were actually doing. So we have to take 66 with a grain of salt. We're back down around 25. That's good news, but it's not necessarily telling us that we're out of the woods yet.
Jim, what would tell us that we're out of the woods?
Well, we look at VIX 20 as a bit of a bright line. Nothing's ever completely a bright line. But we'd like to see VIX get down below 20. We'd like to see the equity indices continue to heal and move back higher as they are this morning. But, investors were shocked by this. And I think many of them are going to be tentative getting back in.
It's interesting, though, because the VIX spikes typically lead to stronger forward 6 month returns, particularly when it's in the range that we saw on Monday. How long would you anticipate the upside for the VIX lasting here? Is 6 months a comfortable range for you, or would you say even longer than that potentially?
Well, there are a lot of things going on in the macro background. And what happened Thursday, Friday, and Monday was triggered by a number of unwinds. I think looking forward, we have a presidential election that's going to dictate a lot of what the economy and the markets look like. But I certainly think we're going to get some clear indications even sooner, even in the next several weeks or month, about how the market's digesting this.
And Jim, I find it fascinating, the market sentiment around these moves, because just a couple months ago, I was having a source coffee with someone who couldn't stop talking about how annoying it was that the VIX was so low and how that was indicative of market concentration. Now it's high and people are upset about that too. What gives with, there's just nothing that makes people happy right now.
Well, I think that's a classic, right? In VIX circles, when it's trading the way it was stuck between sort of 11.5 and 14 for probably close to 3 months. And what we say is it's quiet, too quiet. And that sooner or later it will come out of that range. And we did see it come out of that range. So no, you can't make everybody happy in either direction. There are people who like a higher level of volatility because it creates trading opportunities. But for the average investor, they would like to see volatility come back down. They'd like to see ranges for the S&P and the other equity indices that look more normal.
Jim, real quick, you mentioned that many investors hate volatility, but maybe there could be some opportunity. What does that opportunity look like?
Well, again, volatility does create opportunity, because if you like the S&P at its July 16th high, then why wouldn't you like it better where it is now? And I think it goes to time frame. If you have patience, if you're a long-term investor, and if you are blessed to have cash to put to work in an environment like this, these can be seen as opportunities to put some of that money to work for the long run. If you're a trader, it could be a short-term opportunity. So volatility does create opportunities. Unfortunately, it scares people into kind of a bomb shelter mentality. They don't want to do anything until things sort themselves out. And at that point, some of the opportunity's gone.
All right, Jim, we're going to have to leave it there. Really appreciate you joining us on all things volatility. Thank you so much. That was Jim Carroll. He's Ballast Rock's private wealth, senior wealth advisor, portfolio manager. Now, moving on to another story we are monitoring here. Cathie Wood and ARK Invest buying the dip. The investor is using the current market reset to add over 24 of her current positions, including more investments in Amazon and Tesla. Just to run through a couple more. So the ARK Innovation ETF, that is ticker ARKK. You can see that on your screen right now, up a little over 3% today, but purchasing Amazon, AMD, and Roku. Now, a fintech-focused fund of the firm ARK Investment Management also added Reddit and Meta. That is according to some tabulations that are put out by the firm on a daily basis. And these purchases happened at the beginning of the week. So that is interesting and indicative of Wood's firm kind of buying the dip when it was at its strongest earlier in the week on Monday here. And it's interesting, though, to compare and just give a little bit of size and scope, because we know that ARK is down more than 20% this year. Some 75% of its value has been wiped off since the peak in early 2021. So it is interesting that we continue to monitor this ETF as much as we do, but the street loves to look at Cathie Wood's investment moves as potentially an indicator of something to come.
Yeah, exactly. And I think she's going in, buying the dip, and a lot of these tech favorites, or some of them have been tech favorites in the past when you take a look at Amazon and also that recent run-up that we had seen in Tesla before the recent pressure. Not necessarily a huge surprise, but again, many people are closely tracking Cathie Wood, given her track record over the past several years, some of the success that she has had. But it is important to say that her ARK had hit the lowest level of the year here going into that. A lot of that due to the broader pressure that we've seen across the markets here. But again, Cathie Wood seeing a reason to buy some of these names, and Amazon, I believe, adding that to 3 of her funds. So again, seeing real opportunity there on the heels of some of the pullback that we have seen in Amazon stock.
Absolutely. Well, coming up here, the presidential election is hitting full swing. What could a potential Harris administration look like for the economy? We'll discuss the impact when we get back. Let's turn now to the presidential election. A new poll from Marquette University Law School showing Vice President Harris opening up a 6-point lead among likely voters over the former president. And with her campaign now just 3 weeks in, we want to dive a little deeper into some of the policies from Vice President Harris that could impact the broader economy. So joining us now on set, we've got to welcome in our very own Rick Newman. Rick, always a treat to have you in person with us. So let's start on the macro economy. What are the biggest potential policy positions she could put into place if she makes it into the White House come November again, I guess, that could impact the macro environment?
I mean, the starting point is that she represents the Biden administration. Mm-hmm. So it has been the Biden-Harris administration. So on most things, she basically supports Joe Biden's policies. implicitly anyway. And she has been actually, I think, pretty careful not to talk very much about policies because things are going her way as they are. She's getting criticism for not doing any press conferences or any media interviews. But look what's happening in the polls. I mean, you just mentioned that poll where she's up 6% in one poll over Trump. I mean, that is a gigantic flip in what's been happening. And if you look at the aggregate of all polls, she has gone from considerably behind Trump to now slightly ahead of. I mean, that is just a gigantic movement. And we haven't even gotten to the convention yet, or the so-called convention bump, where you dominate prime time for 4 nights, and then everybody says, oh, I'm paying attention now, maybe I like these people more than I thought. So momentum is going her way. So the real question is, where does she differ from Joe Biden? And if there's any place where she might be more emphatic than Biden, it's on what people call the care economy, care, which is families, stuff that supports families. So she might push harder for expanding the child tax credit, for example, which was in place for a while as part of COVID relief, but that expired. Interesting that she chose Tim Walz, whose main thing he's known for in Minnesota is free lunch for all kids in public schools. She supports stuff like that. So she might push harder for those. Biden supports that kind of stuff too, but you remember he had this whole agenda to build back better. There was everything under the kitchen sink was in there, and he have to pick and choose. So she might emphasize these things more.
And Rick, while we have you, you also have a recent column out on what exactly a Harris presidency, a Trump presidency would mean for the national debt. Doesn't sound like it means anything positive here under both.
Okay, my question to the audience, does anybody care about the national debt? And
I heard you got a heck of a lot of comments on your article. That was
not
my
just
question
do you care about it as an issue, because people definitely read these stories, but here's what everybody wants. They care about the national debt, but they think somebody else should pay to fix the problem. Everybody's like, no, raise taxes on the wealthy, don't touch my benefits or anything. I'm a Social Security, Medicare enrollee. No, don't touch my benefits. Make somebody else pay for it. The fact is, everybody is going to have to give up a little something by the time we address this problem. That's why it doesn't get addressed, because no politician can tell voters, oh, in order to address the debt, I'm going to trim Social Security benefits and we're going to reformulate Medicare or something like that. So just get to the point, Trump wants to cut taxes by extending all the 2017 tax cuts. That's about $6 trillion added to the national debt based on the baseline now. Kamala Harris wants to do some other tax cuts. She would add about $5 trillion to where we are right now. So both candidates, based on what they say they want to do, only going to push the debt upward.
Which is, by the way, we haven't heard a heck of a lot about it from either candidate, too.
No, you won't, because the trade-offs suck.
All right, Rick, there we go. Sum it up in just that one line. Rick Newman, always great to have you here on set. Thanks so much for hopping on with us. Keep right here on Yahoo Finance. You've got wealth. It's dedicated to all of your personal finance needs. Brad has you for the next hour. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, less Americans filed for first-time unemployment benefits than economists anticipated. We'll talk about what it means for the labor market and for your job hunt. And we're diving into your investment portfolio to take a gander and help you navigate investing during times of increased market volatility. Plus, we're closing in on the start of a new school year. Yeah, we're going to talk to a student loan expert about how decisions where you go to college could weigh down some of those future earnings, but we're going to try and all do it right here. That and much more coming up throughout today's show. Stocks on the rise. The Dow jumping, as Destiny's Child would say, over 500 points right now after a fresh jobs data boosts investor optimism about the state of the economy right now. The number of people filing for unemployment unexpectedly dropping last week. There were over 233,000 jobless claims filed. That's down about 17,000 from the week before. So to break down what the signals for the broader economy, with us, we got a good friend of the show, Stephen Risciuto, who is the Mizuho Securities U.S. Chief Economist. Great to see you, Steve. So just take us into now the best pulse that we should be looking to get a sense of where the employment situation is moving on a week in, week out basis at this juncture, given that that previous monthly jobs report was so much weaker than expected that it really rocked the markets.
Yeah, I mean, you're asking a really good question, and the question really gets down to what can we glean from the claims data? What you can take away from the claims data and the continuing claims data is essentially that companies are not in a position where they're being forced to lay off workers. And this is an important component of what's happening. Companies are still seeing the demand that requires them to hold on to the workers they have, but by the same token, their earnings are being squeezed somewhat, which is why we have some disappointing earnings numbers, especially in some of the consumer categories, that are leading to a slowdown in employment. So what you're seeing between the earnings numbers and the claims numbers are kind of explaining the dynamic in a labor market where you're not firing workers, but you're slowing the pace at which you're hiring because you're running into cost considerations. And this is an important point because it tells you the economy has transited from an above trend growth trajectory back to a trend growth trajectory. And that's a sustainable long-term scenario.
When you say cost considerations, let's perhaps bring that into the wage equation here, because I think that's what you're alluding to there. Just take us further into how we should be tracking the moderation in wages. And for those who are out there on the career hunt, what their expectations realistically should be at this juncture.
Well, we're not really seeing much additional deceleration in wages, which is the reason why you've got the cost pressures that are unfolding. We've seen a little bit of a slowdown in the pricing power, and the net result is companies are getting squeezed in the middle of that. Wages are still effectively running in the 4% area, and that's really where people are looking to get their get increases in their salaries over time. But the cost structure goes beyond that. If you just look at what's happening to container costs again for corporations. Container costs are up. You look at what's happening in terms of a reduced value of the dollar, and that's going to basically create a bit more import competition coming into the U.S. economy as well, which then also creates an environment in which basically it reduces pricing power. So companies are kind of getting squeezed in the middle of that. The earnings are reflecting that, but we're still got an equity market, which, remember, we're still up about 9% in a year where we're expecting earnings of about 10 to 11 after being up over 20% last year, and we saw earnings growth of only about 1.7%. So, the equity market, despite the correction phase, is still in a very healthy position, and it's really showing you the net underlying environment that this economy is on a sound upward trajectory. All these people who are raising their percentages of recession stories, I think, are making a mistake.
And so, as that carries through to the rate decision and your expectations there, because, even with some of the musicians that I play with on weekends, for our conversations that are not music specific, it's gotten into, hey, how much do you think the Fed's going to cut? Because they're hearing 50 basis points, and I'm like, whoa, you guys are tracking this. But yeah, everybody is, because I guess we're all sitting here waiting for when that first cut will come, as we're pointing towards September right now. But the depth to which that cut comes is increasingly being discussed about with economists such as yourself. So do we see 50 points in September?
No, I'm not in the 50 basis point camp. I'm in the 25 basis point camp. I also think the market is much too aggressive in thinking that we'll have 5 rate cuts by the end of January. The reality of the situation is people want to look for that first rate cut because they believe it will lead to a programmatic series of rate reductions that'll move the Federal Reserve to a subsidy level of interest rates, and that'll tell everybody in the equity market, gee, it's great to go out and buy absolutely everything because everything's just going to go up and the economy is actually going to accelerate like mad and earnings are going to take off through the roof. The reality is that's not the macroeconomic scenario we're looking at. We're looking at an economy that has transited to a slower trajectory. There is some risk for upside potential if the Fed overplays its hand. But the reality is we're not going to go back to a subsidy level of rates. And I think there's been too much hype over the recession story because in the last 4 business cycles, a recession did begin after the Fed cut rates. But the first 3 of those cycles were credit cycles, and there's no credit crunch this time. And the fourth, the final, was the COVID environment. And the government lockdown mitigation strategy caused a recession. So yeah, the Fed cut rates and there was a recession. Typically in an environment like we're dealing with today, when there is no credit crunch, the Fed cuts rates at the bottom of the growth cycle, not at the top of the growth cycle.
Steve, good to see you. Thanks so much for hopping on with us. Steve Rasciuto, who is the Mizuho Securities U.S. Chief Economist. Good to see you. Thanks. It's been a volatile week for the markets, so we want to talk about how you should view this week's moves when it comes to your own portfolio. Here to help, we've got Sandra Cho, who is the Point Wealth Capital Management founder and CEO. Great to have you on here with us. So as we're trying to kind of take a deep breath, and we're seeing the major averages at least up pretty handedly here as of right now, we're still trying to erase some of the consecutive declines that we had seen. So what is perhaps the point of calm that you're telling even your own clients right now?
Thanks for having me. Yes, it has been kind of a whirlwind of the market. We've been used to very low volatility, and all of a sudden when those the unemployment numbers came out and jumped from 4.1 to 4.3, the markets definitely reacted. That said, we haven't even really had a correction. The market is down about 6.5% from the high. And what I'm telling our clients and what we're saying is, look, we've talked about this. One of the best things to just know in your heart is that there is going to be volatility in the markets, and to accept it, and and then just lean on that diversification. So it's a good time to rebalance. Most people are now slightly overweight stocks because stocks have had such a run up, AI stocks in particular, large cap growth. So you really definitely want to make sure that you rebalance. You want to make sure you have a financial plan, because if you have that financial plan, you're able to look a mile out instead of focusing on the small bumps in the road right now.
With that in mind, you mentioned diversification. For portfolios that are perhaps over-indexed on the Mag 7 trade as either annexed to the theme of generative AI or something else within that Mag 7 kind of profile, what are you sensing right now? Is there rotation that you're seeing out of Mag 7, or where is that diversification kind of leading people who had been over-indexed in Mag 7 to kind of go into?
Yes, if you've been in the Mag 7, if you've made that play with the AI stocks, good for you. There's been a huge run up. That said, at what point do you start taking those chips off the table and cashing them in? So, like you said, we have been seeing a rotation, and we've been seeing that. You look at the NASDAQ, you look at when there was that jump in the VIX, and you saw the NASDAQ really go down. More than, say, some of these more value-oriented stocks. That's basically, what we are, telling our clients is that there's a reason why you were diversified. There's a reason why we didn't have you 100% in Nvidia, right? So we are seeing that rotation. We're seeing it even now, though the NASDAQ has jumped today. We still believe that that rotation is going to continue over the next few months and possibly even longer, where you see the Russell small cap kind of coming up. You see the unloved sectors like utilities and real estate and healthcare that didn't do well last year really kind of come up over the last month and outperform relative to those AI Mag 7 stocks.
Since you mentioned AI, we got to talk about the poster child of AI right now. That is Nvidia. Do you expect that to be the bellwether that it has been in earnings seasons past?
Nvidia is a great, strong company, and they've got a 10-year jump on their competitors. That said, Nvidia and a lot of other AI and tech large cap growth companies have had to put a lot of investment into AI that they haven't necessarily seen the fruition in revenue yet. So do I think it's going to go up? It really depends on your timeline. If you're talking about 10 years out, yeah, why not? Perhaps. But if you're talking about over the next, year or so, how can it really maintain the kind of growth that it has had, in the past, year and a half? I think that's going to be difficult.
Certainly. Sandra Cho, who is the Point Wealth Capital Management founder and CEO. Thanks so much for taking the time here.
Thank you.
Certainly. All right, let's switch gears. Turning now to a trending stock on the Yahoo Finance platform today, Robinhood. Shares rising on record high revenue, some attributing the rise to the run-up that we saw in crypto and meme stocks earlier this year. Here with some insight, we have Robinhood's CEO, Vlad Tenev. Vlad, great to speak with you and grab some time here. I mean, I imagine over the course of this week with the sell-off we had seen earlier, then your own earnings, you've probably oscillated from espresso shots to maybe just, ripping Celsius. I don't know, but I imagine it's been extremely busy for you. So thanks for taking the time. First and foremost, let's just start with what we've seen in the market activity more broadly. What goes through your mind as the CEO of a trading platform as large and as international as Robinhood when you do see activity like that?
The activity so far in August has been large. We announced these Q2 results yesterday, and in that earnings call, we talked about July volumes being 20% higher than June, which was the last month of the last quarter, and August has been more of the same. And August is typically a pretty quiet month for retail trading activity, and we haven't seen that this year. We've had $1 billion in net deposits in the first week of August, and the $13 billion we had in Q2 was a record high for us. Just Monday of this week was about $500 million of net deposits into the platform in one day. And then 24-hour market, which Robinhood was a pioneer in, which offers overnight trading in over 1,000 US stocks. That was 3x normal volume on Sunday. So the things that go through my mind are making sure that the system is reliable and performant for customers. On Monday, the majority of the incumbent brokerage competitors were having issues. And those are opportunities for Robinhood to distinguish ourselves because of our technology and kind of position the product as a reliable platform for people when so many others are having issues. And I think customers should feel that they have advantages using Robinhood and they would be disadvantaged by using another platform, which I think you're starting to see with 24-hour market. We offer opportunities that you can't get at other brokerages, and also with reliability at the most important times.
Should investors be bracing for more volatility given what we've seen in the recent trading sessions here? We've had a little bit of a bounce back or an attempted bounce back, but is there, and I know that you used to be in high frequency trading back in the day, is there more that they should be bracing for?
Well, there's a lot of different types of market participants, right? Traders who typically are more advanced, and Robinhood had a slew of active trading products, including options trading and margin, equities and crypto. Those traders look at volatility as an opportunity because they have sophisticated strategies that they can employ when markets are going down and sideways. For the more buy and hold investors, typically they're saving for retirement and they have long-term time horizons. They tend to look at opportunities like this to buy stock and accumulate at discounted prices. One of the things we've been seeing thus far in August is more buying than selling. And that's why we've been seeing so many deposits. Our customers generally have been seeing this as an opportunity to add to their positions.
You know, it's really interesting in some of the figures that you reported. I mean, at the same time that you've got Olympic athletes competing for gold, you've got your own gold subscribers as well right now that are continuing to show some strength for the company, reaching a new high of 2 million. I think that was up 61% year over year. Take us into how you're looking to really capitalize on some of the gold features and make sure that that is a direct pass-through to some of the ARPU figure, that average revenue per user.
Yeah, I mean, what we're really seeing is the flywheel of Robinhood Gold spinning. As we have more and more gold subscribers, we offer our gold subscribers lower prices across all of the products that are in gold. And that leads to higher wallet share and increased multi-product adoption. One stat that I use is gold subscribers adopt retirement at 5x the rate of non-gold subscribers. And this leads to higher ARPU and increases our ability to lower prices further and leads to the diversified business you're seeing today. We now have 8 business lines that are generating 9 figures in annual revenue. So that's 8 business lines at over 100 million per year. Robinhood Gold subscription being one of them. And so, and we believe we can add more. We're going to continue to add more. And so the business is getting more diversified over time as we're growing each segment. And I think that really makes me optimistic about the opportunity and that we're just at the beginning of it.
And when you talk about those segments, I mean, you also just recently went through 2 major acquisitions. In June, you mentioned Bitstamp, and then additionally, you had the acquisition for Pluto as well. That was more on the AI side. As you think about these acquisitions and how they help define the era that Robinhood is in right now, you know, how would you define the era that this company is finding itself in and where growth is firing at perhaps the most popular cylinder for where you're seeing users come onto the platform?
Yeah, well, you know, one of our analysts said yesterday, Robinhood is firing on all cylinders and adding more cylinders, which I rather liked. I think that was pretty clever. The era that really gave rise to Robinhood was mobile and cloud. Those are 2 big technological shifts that allowed us to carve out a niche in our business because nobody had been really paying attention to mobile. Most of our competitors, I mean, pretty much all the big ones are brick and mortar. You know, they have stores, they rely on people rather than technology to expand. And I think that created the conditions for us to be successful by being a technology company and offering lower prices than our peers in financial services. Now there's another 2 technological shifts that are going to affect our space. And those are artificial intelligence and cryptocurrency. Both of those have the potential to completely reorganize how financial services are delivered to customers, both on an infrastructure level and the service level. And we're thinking about that every day and positioning Robinhood to be successful and a leader across both of these shifts.
Is there one that you would prefer Robinhood to be known at excelling at? The artificial intelligence side or the crypto side, as you had talked about a lot going into the public debut for this company?
Well, that's a tough question. It's like asking me which of my 2 children I find more beautiful. I think both are important and both are inevitable to a certain extent. So we don't have to choose. We already have, you know, a very large cryptocurrency business. In retail market share, it's been growing and it's kind of been a dark horse in the space. Not a lot of people think of Robinhood as a major player, but, you know, in retail crypto, we're right up there in market share and we're continuing to grow. And then artificial intelligence, the financial services industry hasn't really embraced that. And I think it's incumbent on a technology company that started with that DNA of being technology first to make sure that the financial industry can navigate that transition successfully and safely. So I think both are important. It's hard to pick between one of those two technological shifts. It's kind of like asking, what's more important, mobile or cloud? They're both happening, so we have to make sure we're ready for it.
Certainly, we'll accept that. All right, I got to hustle to my finish here, Vlad. First, when you think about the softness in the IPO market, I mean, this is a feature that you had really worked on bringing to the platform users here. When you see softness in an IPO market, does that typically push some of the subscribers, some of the users over to just other crowded trades that are already happening?
That's a good question. I mean, I haven't really thought too much about the link between IPO investing and other trades. I would tell you that I do think it should be a little bit easier for companies to go public. I mean, if you look back in the 80s, companies like Apple and Microsoft went public at relatively low valuations. And what you're seeing now is companies getting most of the value appreciation in private markets where they're only accessible to accredited investors. And I think that needs to be fixed. I think the cost and the burden of companies going public needs to go down, because it used to be that, if you get to 100 million in revenue, that was kind of the moment at which you were sort of public company ready. But now that number's gone much, much higher, and companies are staying private longer, and the appreciation is not seen by retail, which we think is a big problem.
And just lastly, while we have you here, Vlad, the name of the show is Wealth. And for a lot of our viewers out there, they're aspirational towards building their own wealth, being able to retain it, and ultimately get to a stature like you have as well. If you had a message to your younger self just about making sure that you were building a product that you could be proud of and that would help you amass but also retain wealth over time, what would that message be to your earlier self?
Yeah, well, now that I'm older and hopefully a little bit wiser, you can see the gray hairs on my beard. My message would be that I think we tend to overestimate what we can do in the time span of weeks and dramatically underestimate what we can do over a year or two. And I keep being surprised at this. So I think having that perspective, you can start long journeys and chip away at it systematically over a time period of many years. And it's really about figuring out what the smallest step that you can accomplish is, and just making sure you make progress every day. I think it's a lesson in life, but also in investing. I think we have a lot of impatience in how we approach things in business generally. And I think having the perspective and seeing a long time horizon and seeing that play out, I think that's one thing that you gain from just being around longer and having that wisdom. So if you can grok that, I think you're ahead of 95% of the people.
I don't see any grays, so you're doing good from our perspective here, Vlad Tenev, who is the CEO of Robinhood. Thanks so much for taking the time.
All right, thank you.
Absolutely. Coming up, is EV demand flatlining? The latest quarterly results from EV makers and infrastructure companies show continued weakness in the sector. I talked to the CEO of Blink Charging next about this on Wealth. The EV market has been under pressure so far this year, and Blink Charging lowering its revenue guidance, citing, quote, short-term softening of EV demand. We've got Brendan Jones, who is the CEO of Blink Charging, with me on this. Great to see you again, and thanks for hopping on here. I mean, we were just showing the stock price. We were talking about what the outlook is. Take us into what you're seeing in EV demand right now.
Sure, and it's a great question, and it's absolutely a hot topic right now. So, global vehicle EV sales are increasing, and globally was a 19% increase so far this year. So that's a very, very positive sign. But what we did see in the US market is there was a bit of a slowdown in EV sales in Q1. And that sort of trailed into Q2, with June, however, showing very promising signs, and it was up over year by about 200,000 vehicles in the US. So, there was a softness, a dip. Now it appears to be bouncing back. Our June data for charger sales also reflected that same analysis. So we're going to have to monitor the US sales for the rest of the year. But then conversely, if we look at European, and in particular UK, EV sales and our charger sales and engagement there continue to increase. And that's more of our utilization model, where we own and operate the chargers. So globally, where more EVs are on the road, we're seeing higher utilization and then higher service revenue as a company. So you got some softness, then you have a lot of positive, and then we see global growth continuing. That's the status as we see it.
We see increasing studies that show that EV drivers want to be able to charge in 20 minutes or less. And of course, the ranges vary, but all that considered, is that possible? Is it possible to get into that 20-minute full charge range?
You can, but the question is there really need for fast chargers everywhere? And the answer is no. All the global studies, whether they come from McKinsey and several others, indicate that you need 90% of the chargers globally where vehicles charge are going to be L2 chargers. So you charge the vehicles where they sit. And unfortunately, the vehicles we purchase, they sit 95% of the time. So then about 10% of the time, you need fast charging for when you're on a trip, where you're going on regional travel, etc. And we have to focus on that healthy blend and that healthy ecosystem of charging. And A, it takes less capital to get there. And then B, it provides the most advantages on charging. Once you own an EV, most respondents tell you, I charge mostly at home, or I charge mostly at work, or on an L2 charger. When I need a fast charge because I'm on a long trip, that's when I engage with DC.
I'm taking a look at the product revenue side of the business here. It was down 4% year over year. As you think about being able to generate demand going forward, what is that calculus for the company? How do you go out into a market like this and, understanding the environment, generate that demand that passes through to the financial performance?
Well, largely on the product sales, we follow the OEMs. So as sales increase, then our sales of charging services on the product side are going to increase as well. And most of those increases you're now seeing in the multifamily dwelling space and the fleet space. And where we have an advantage of it is we're a fully vertically integrated company. So we produce a significant portion of our chargers. And as a result, being a full service EV infrastructure company, our margin is class leading. So with vehicle sales rebounding now and increasing globally, and indeed increasing in the United States, we see positive outcomes as we move forward. There were some great months as we ended 2023, and we had a great first quarter. We definitely saw the lingering effect of slowdown in vehicle sales in Q2, but we see a bounce as we continue to move through Q3, and definitely a significant bounce into Q4.
Brendan Jones, who is the Blink Charging CEO. Brendan, great to see you. Thanks so much.
Absolutely.
All right, right after the break, everyone, we're speaking to the co-founder and co-CEO of Warby Parker on what the company's earnings reports say about the consumer. You won't want to miss that. That's right after the break. Warby Parker shares in the green after the eyeglass retailer raised its full year guidance as active consumers, those customers, continue to spend online. To discuss, we've got with us Dave Gilboa, who is the co-founder and co-CEO of Warby Parker. Dave, great to check in with you, and thanks for taking the time here today. On the back of this earnings report here, I mean, net revenue up 13%, active customers up 4.5%. Take us into the consumer as you see them through the Warby Parker lens right now.
Yeah, thanks for having me on. And we're proud of our Q2 results and the progress that we've made so far this year. We really set out to accelerate our active customer growth, which we've now done 4 straight quarters. We've seen our e-commerce business return to growth, with Q2 being the fastest quarterly growth since the beginning of 2021, and are making progress against our long-term strategic initiatives. There's no question that many consumers are feeling pinched and are being more thoughtful around where they're spending dollars. We feel fortunate that we serve mainly high-income segments, so our average household income is over $100,000, and we sell products that people need to see. And so we're seeing a more intentional consumer, where a higher percentage of our customers are starting with an eye exam and then buying glasses versus kind of casually shopping and coming in with bags from lots of other stores. But we're encouraged by the progress that we're seeing in our business and our ability to serve our patients and customers.
And when you think about the retention of that higher end consumer, I mean, how many engagements are you typically seeing with them over time?
Yeah, so we find that once someone shops with Warby Parker, they tend to love the experience and they tend to come back over time. And so we've seen very consistent retention metrics across cohorts. We tend to see that if someone buys, they tend to come back and spend as much in that initial purchase with us over the next few years. Now, buying a pair of glasses or getting an exam is not something that most people undergo every month or every quarter, but we do see our customers coming back year after year.
We've seen some considerable movements in vision insurance. I wonder from Warby Parker how you're seeing customers really lean into making sure that they have that vision insurance that is able to offset some of what their expenses would be out of pocket typically with Warby Parker and what that means for the company and its own financial performance.
Yeah, so we've really focused on being able to deliver great value, whether our customers are paying out of pocket or using insurance benefits. But we want our customers' dollars to go as far as possible. And so we've been working on expanding our insurance coverage. We're in network with United Health, and we announced earlier this year that we're adding all Versant Health members will be able to use their in-network benefits at Warby Parker, and that integration is underway. We've also been focused on serving out-of-network customers even better. And if you go to warbyparker.com/insurance, you can just enter your name, your birth date, and your zip code, and we'll tell you what your insurance benefits are and how to use them at Warby.
Just lastly, while we have you here, you, of course, do the ever-popular frames, but you also do, and of course, tests, but you also do contact lenses as well here. You know, what are you seeing in the performance of that business? I mean, we know that it's been one of the elements to try and really diversify the strategy for Warby Parker over the years.
Yeah, so we've seen massive growth in our contacts business. We know that around 40% of our glasses customers wear contacts, and it was the most requested item before we offered it. People wanted to buy glasses and contacts at the same time, and now we offer that. And we're seeing really rapid growth, contacts growing around 40% year over year, and are excited to continue to scale that business.
As more people are perhaps even trying to look or lean into their insurance and see if they're covered by, LASIK or any other eye surgeries, is that a headwind risk that you're seeing become elevated at Warby Parker?
This is a category that has a lot of durability. We sell products that people need to see. And if anything, the incidence of refractive error and the need for glasses and contacts is only increasing. And so we remain highly confident in the long-term durability of the category and the need for the products that we sell every day.
Certainly. Dave Gilboa, great to see you. Good to check in with you. Warby Parker co-founder and CEO. Tell Dave we say hello to
him.
Yeah, Dave, thanks so much. All right, much more on wealth after the break. You're watching Yahoo Finance. We'll be right back. Feeling weighed down by student loan debt? Well, guess what? You're not alone. As students head back to school, a major concern for many is managing student loans. And while loans can stunt financial growth, there are effective strategies to manage debt while working towards those financial goals as well. For more, I'm joined by student loan expert Mark Kantrowitz. Mark is the author of the book, How to Appeal for More College Financial Aid. Mark, good to have you back on the show with us. All right, so for those who are just trying to get ready for this school year and perhaps still need a little bit of financial aid or even instruction going into it, is it too late to get some of that financial assistance before the school year starts?
It's not too late. You can file the free application for federal student aid or FAFSA form by the end of the academic year. So it's better to file it sooner because some money runs out, but there is still a lot of money available, including the student loans.
And so if you are appealing for more financial aid, what's the best way to go about that?
Well, contact the College Financial Aid Office and let them know about any changes. That can include a change from the prior year, which is the year upon which the FAFSA data is based, to the present year, like job loss or pay cuts, anything like that, as well as anything that differentiates you from the typical family, such as you have high unreimbursed medical or dental expenses, you have a special needs child or elderly parent that you're covering extraordinary costs for, anything that differentiates you from the typical family.
Can we toss that stat back on the screen? The rising cost of college over the past 2 decades, 179%, according to the Education Data Initiative here. Mark, when you see a figure like that, I mean, it really makes a lot of families rethink how much they're paying, what they're paying for in terms of the major that someone might be going into the school for, and even the type of school. So What is the risk assessment that families are right to really discuss prior to entering into that new school?
Well, first question will be, can you afford the cost? Some families just kind of wing it and hope that they can afford the cost, but then they run out of money middle of their college career, and that forces them to switch to another college or even drop out. So do a little bit of planning in advance. In many cases, a less expensive college, such as an in-state public college, will cost a lot less than a high-cost private college, and that can save you a lot of money. And also try to minimize the amount you borrow. Live like a student while you're in school, so you don't have to live like a student after you graduate. And borrow as little as you need, not as much as you can.
Certainly. And then, Mark, just lastly, while we have you here, I mean, this has been one of perhaps the landmark campaign points that we've seen the Biden administration from the time of campaigning back in 2020 all the way through the administration really push, and that is student debt relief. If we do see any type of changing of the guards in the Oval Office come November or January after the election, what does that mean for those student loan debts that are out there and still existing?
Well, so President Biden has forgiven more student loans than any previous president using existing programs. So a total of 4.8 million borrowers have received 168 billion in student loan relief. That's about 10% of the total. He is pushing changes to the SAVE repayment plan to replace the repay plan, but that's being opposed by several lawsuits. And the next administration, if it changes, might drop the defense of those lawsuits, in which case the SAVE repayment plan may be eliminated. In addition, the Trump administration opposed public service loan forgiveness, while the Biden administration supports it. To get rid of public service loan forgiveness, however, will require not just control over the White House, but also control over the House and the Senate. So it's a little bit more difficult to get rid of that loan forgiveness program.
Great layout there and reminders. Mark Kantrowitz, who is the student loan expert and author of How to Appeal for More College Financial Aid. Thanks so much again, Mark.
Thank you.
Certainly. Well, college, it's expensive. And costs, they're only rising. The average American spending more than $25,000 annually for undergraduate tuition and other costs like room and board. And while scholarships play an important role in our college attendance, the reality is that only a small fraction of students receive scholarships, and most awards are insufficient to cover any significant costs. Here to weigh in on her own application experience, we've got our very own Madison Mills. Hey, Maddie.
Hey, Brad. So I'm now embarrassed at thinking about how long ago this was. But when I was applying to college a while ago, I was able to apply through a scholarship program called QuestBridge. And interestingly, I found out about this program because I had a history teacher in high school who posted about scholarships on our whiteboard every single day. Oh, yeah. That's the only way I knew about this scholarship. So shout out to the teachers telling their students about scholarships out there. But what's interesting about QuestBridge is that it is for low-income, high-achieving high school students, and you're able to apply to a basket of schools under one application, which is also really important for low-income students who struggle to pay for several college applications. Those costs can really add up. QuestBridge matches you, though, with a school, so you don't necessarily get to pick which college you end up at. I was very lucky to get matched with the University of Southern California. Going to college in LA for 4 years was not too bad, and you don't have to pay for it. So my tuition was fully covered through QuestBridge. But for the types of students who are applying to a program like QuestBridge, and it's not just them, there's also Posse, there are several other national scholarships that help you get that full tuition aid. But full tuition is not going to be enough if you're coming from a family that is not able to contribute to your education education. So I think it's really important to note that there are local scholarships that folks can look to fuel those additional expenses, things like room and board, obviously food. And we were talking about this earlier, only 0.2% of college students get scholarships worth $25K or more. So applying to a lot of different scholarships will help you fuel that broader bank account you can pull from for that room and board and the lifestyle that you want to be able to have while you're in school. When I was in high school, I applied to nearly 100 scholarships at the local level.
Wow.
I had a lot of individual ones that were able to help me. They just basically send you a check. So that's really useful for paying for things like, food and of course room and board and whatnot. But I would recommend looking at hyper local scholarships and anything that you can tie to a hobby that you might have, because those are a little bit less competitive than if you were to just Google, scholarships. A lot of people will be applying to those national ones. So try and look at the hyper local ones as well.
Yeah. My only advice, make friends with the dining center security. That's all I got.
Oh, that's a great, we could talk about that.
We could, yeah, indeed. Maddie, thanks so much. A much more useful piece of advice from Maddie. Thanks so much. Guys, coming up, Duolingo reporting another profitable quarter. We'll talk to their CEO when we come back. Duolingo, the language learning app especially popular with Gen Z and millennials, reported its latest earnings yesterday, once again beating expectations. For more on the quarter and what lies ahead for the company, we've got Luis Van On, who is the Duolingo CEO. Luis, great to have you here with us. All right, just take us into what you're seeing into those who are using Duolingo right now and the engagement that is really kind of running rampant on the platform.
Yeah, well, thank you for having me here. Well, we have users in every single country in the world. And the reason that people want to use it is there's multiple. I mean, for some of them, it's a hobby. For some of them, is because they want to learn English for work purposes, et cetera. But in all cases, the thing that really keeps them coming back is that Duolingo is a lot of fun.
I mean, you've got this new fun way of kind of gamifying Duolingo as well through the streaks. What does that typically do for Duolingo's bottom line? And I mean, I guess at the same time, what does it do for a lot of the people who are using the platform?
Yeah, when you use Duolingo, there's this number called a streak, which just measures the number of days that you've used Duolingo to learn in a row. So if you've learned for the last 7 days in a row, you have a streak of length 7. And if you miss a day, your streak goes down to 0. This is a very important engagement mechanism. And our users are, we have a lot of users with very long streaks. For example, we have over 7 million daily active users that have a streak longer than 365, meaning they haven't missed a day in the last year or longer. And that's about 20% of our daily active users haven't missed a day in the last year. So it's very engaging.
That's incredible. When you think about the 100 million monthly active users that you've been able to surpass, 8 million paying subscribers, how are you kind of going about conversion for those subscribers and getting them into a paid status versus just what I'm sorry to admit, Luis, I might be on the freemium.
You got to pay. They probably pay you enough. You got to pay. Well, in reality, we like our free users too. I mean, we have, as you said, we have over 100 million monthly active users. About 8 million of them are paying subscribers. And in general, that number, the fraction of people who are monthly active users that are also paying subscriber keeps going up. It's been going up about 1 percentage point every year historically, and we expect it to continue going up. And the way we make it go up is by basically adding more value to the paid tier. So if you subscribe, you don't have to see ads, and also you get all kinds of extra features.
Are the prices going to go up soon? Is that what you're saying?
No, we're not increasing. We're always testing prices, but we don't have a plan to wholesale increase prices.
Got it. What are you seeing in the service itself, and what users are gravitating towards, especially as, I don't know, maybe somebody was gearing up to go to the Paris Olympics. That's almost over. So what's the next major kind of event point if you're not going to, a world tour from Taylor Swift or going to the Olympics, that you see users gravitating towards the platform for?
Yeah, definitely when there are events like the Paris Olympics, we do see people gearing up and learning French. We also see that with streaming service shows. So, for example, K-pop shows that are popular, whenever they release, we see a lot of people learning Korean. So we see that all over, for the different languages. People just want to learn the different languages that are important because of pop culture. But so we see that, but the vast majority of our users are actually committed to a very specific language. So either because they want to learn Spanish or because they want to learn English, etc.
Just lastly, we have 15 seconds, Luis. AI within Duolingo, what's that look like for users going forward?
Oh, we're very excited about AI. The thing that we're most excited about is being able to practice conversation with an AI on the other side. That really teaches you a lot better. And the reason that's interesting is because normally people are very shy about practicing conversation with another human in a language that they're not very good at, but they are completely okay practicing conversation with an AI.
All right. Great short answer there. Luis von Ahn, who is the Duolingo CEO. Great to see you, and thanks so much for joining. We got to continue this conversation in English for right now until I brush up on my French. I appreciate that.
Please do.
Yes, we'll do. That's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time. You do not want to miss it.